There is a peculiar truth about money that most people never discover, and it is simply this. The wealthiest people you will ever encounter probably do not look wealthy at all. They drive ordinary cars, they wear unremarkable clothes. They live in neighborhoods that would never make it onto a television show about the rich and famous. And this is not because they are secretly miserable or denying themselves pleasures. It is because they understand something fundamental about the nature of wealth itself, which is that true wealth is invisible by definition, because wealth is not what you spend, it is what you keep. It is the gap between what you earn and what you consume. And that gap cannot be seen by anyone looking at you from the outside. When you see someone driving a $300,000 car, you are not seeing wealth. You are seeing the absence of $300,000. You are seeing a decision to convert wealth into a visible object. And there is nothing inherently wrong with that decision, but it is important to understand what you are actually looking at. Because the person driving the 10-year-old Honda might have millions sitting in index funds, and the person in the gleaming luxury vehicle might be leasing it while drowning in credit card debt you simply cannot know. And this creates a strange situation in society, where the people we assume are wealthy, based on visible signals, are often the people who are most aggressively converting their wealth into status symbols, while the people who actually have financial freedom are walking around looking completely ordinary. There was a famous study of millionaires that found the most common car brand among them was Toyota. Not BMW, not Mercedes, not Porsche, but Toyota. Because the people who had accumulated real wealth understood that a car is a depreciating asset that sits in a parking lot most of the day, and they would rather have their money compounding somewhere than sitting in their driveway looking impressive to neighbors. They will never invite over for dinner, and this invisibility of wealth means that most people have fundamentally miscalibrated reference points for what financial success actually looks like. We see the spending, we never see the saving. We see the consumption, we never see the accumulation, and so we chase visible markers that are often inversely correlated with the thing we actually want. Topic: the poverty premium. One of the cruelest paradoxes of money is that being poor is actually more expensive than being wealthy, which sounds like it should be impossible, but reveals itself in 1,000 small ways. Once you start looking, the poverty premium is the name economists give to this phenomenon. And it works like this: when you have money, you can buy in bulk and save when you are poor. You buy the small size that costs more per unit, because you cannot afford the large one when you have money. You can buy quality items that last for years when you are poor. You buy cheap items that break and must be replaced again and again, each replacement costing more in total than the quality item would have cost once. When you have money, you can pay your bills on time. When you are poor, you sometimes miss payments and incur late fees and penalties and interest charges that compound upon themselves. When you have money, you can access credit at low interest rates. When you are poor, you turn to payday lenders and credit cards with rates that would have been considered usurious throughout most of human history. When you have money, you can invest in preventive care, whether that is for your health or your car or your home. When you are poor, you wait until things break completely and then pay for emergency repairs that cost far more than maintenance would have when you have money. You have a financial buffer that lets you wait for sales and negotiate and walk away from bad deals. When you are poor, you need things now, which means you pay whatever the immediate market demands. There is a famous line from a Terry Pratchett novel about boots that captures this perfectly. A poor man buys cheap boots for $10 and they fall apart after a season. And he buys another pair and another. And after 10 years, he has spent $100 and still has wet feet. While a wealthy man buys $50 boots that last 10 years and keeps $50 in his pocket and has dry feet the whole time. This is not just a clever observation, it is a structural feature of how poverty perpetuates itself. Money is a tool, and like most tools, it works better when you have more of it. The person with savings has options. The person without savings has emergencies, and the responses to emergencies are almost always more expensive than the responses to planned events would have been. Topic: Scarcity Brain. What happens inside your mind when you do not have enough money is something researchers have studied extensively, and their findings are both fascinating and deeply troubling, because it turns out that financial scarcity does not just limit what you can buy. It actually changes how you think. The brain under financial stress operates differently than the brain with financial cushion. And this is not a moral failing or a character flaw. It is simply what happens when a human mind is forced to deal with constant resource constraints. Researchers have found that people experiencing financial scarcity show reduced bandwidth for other cognitive tasks. It is as if worry about money takes up so much mental processing power that there is less left over for everything else. Decisions become harder, attention becomes more scattered. The ability to plan for the future diminishes because the present is so demanding. And this creates a vicious cycle where the cognitive impairments caused by scarcity lead to worse decisions, which lead to worse outcomes, which increase scarcity, which further impairs cognition. In one striking study, researchers found that simply thinking about a major financial problem was enough to reduce cognitive performance by an amount equivalent to losing a full night of sleep. The participants had not actually lost any money. They had just been asked to contemplate financial stress, and that contemplation alone was enough to measurably impair their thinking. This helps explain why financial advice given to people who are struggling often seems to fall on deaf ears. It is not that they do not understand the advice or do not want to follow it. It is that their cognitive resources are already so depleted by the stress of their situation that implementing complicated new behaviors becomes extraordinarily difficult. The brain evolved to prioritize immediate threats over long-term planning, and financial scarcity registers in the brain as an immediate threat, which means that saving for retirement or sticking to a budget or comparing insurance options all feel impossibly effortful when you are worried about making rent this month. Understanding this changes how we should think about wealth differences. It is not simply that rich people make better decisions and poor people make worse ones. It is that the experience of wealth itself provides cognitive advantages, while the experience of poverty imposes cognitive costs that have nothing to do with intelligence or character. Topic: Time millionaires. There is a concept that the financially independent talk about among themselves but rarely mention in public, and it is the idea of being a time millionaire, which means having accumulated enough wealth that your time belongs entirely to you. Not because you have stopped working necessarily, but because any work you do is chosen rather than compelled. This is different from traditional retirement because it is not about age, and it is different from being rich because it is not about displaying wealth. It is purely about the relationship between your hours and your needs, when you no longer have to exchange time for money. Your entire experience of life changes. The Sunday evening dread disappears because Monday is just another day. You control the constant background hum of obligation fades because nothing external is demanding your presence. Your schedule becomes genuinely yours, which sounds simple but is actually quite rare in modern life. Most people have never experienced even a single week of true schedule autonomy since they first entered school as children. There is always somewhere they have to be, something they have to do, someone expecting them. The time millionaire has stepped outside this structure, and while they often continue to work, they do so on terms that look very different from conventional employment. They might work intensely for 3 months, and then not at all for 6. They might only take projects that fascinate them, regardless of pay. They might structure their days around energy, rather than around clock hours. What time millionaires consistently report is that this freedom changes their relationship with money itself. Once you have enough, that your time is your own additional money becomes much less interesting. Because what would you buy with it? You already have the most valuable thing it can purchase, which is control over your own life. This is why you sometimes meet wealthy people who seem strangely uninterested in acquiring more wealth, and why you meet high earners who seem desperately grasping for their next bonus, despite already having more than they could spend. The difference is not the amount in their accounts, but whether that amount has crossed the threshold where time is truly theirs. Topic: Golden handcuffs. The phrase golden handcuffs describes a particular trap that many high earners fall into. And it works like this: as your income rises, your lifestyle rises to match it. You move to a better neighborhood, you enroll your children in private school, you drive a nicer car, you eat at better restaurants, you take more expensive vacations. And each of these upgrades feels natural at the time, because after all, you have earned it, you work hard, you deserve nice things. And individually, none of these choices is unreasonable, but collectively, they create a situation where you need your high income to maintain your life, which means you cannot leave your job even if you hate it. You cannot take a risk on something new. Even if you dream about it, you cannot slow down even if you are burning out, because the lifestyle depends on the income, and you have grown accustomed to the lifestyle. The handcuffs are golden because the cage is comfortable, but they are handcuffs nonetheless, and the person earning $400,000 per year while spending $390,000 has almost exactly the same practical freedom as the person earning $50,000 while spending $49,000. Both are one paycheck away from crisis. Both are bound to their current employer. Both will find it extremely difficult to change direction, and this is how you get the phenomenon of deeply unhappy people in seemingly enviable positions. People who describe themselves as trapped, despite earning more in a year than most people earn in a decade, because income is not freedom. Spending less than you earn is freedom. The gap between what comes in and what goes out determines your options, and when that gap is narrow, your options are narrow, regardless of how large the absolute numbers might be. The bitter irony is that the same ambition and drive that propelled someone to a high income often keeps them locked in the spending patterns that eliminate the freedom that high income could have provided. They climbed the ladder only to discover they had locked themselves onto it. Topic: Lifestyle creep. Lifestyle creep is the name for what happens almost automatically when income increases, and it is called creep because it is gradual and often invisible. At first, it might be small things you upgrade to the premium streaming service. Instead of the basic one, you order the slightly nicer bottle of wine at dinner. You stop checking prices quite as carefully at the grocery store. None of these individual decisions seems significant, and none of them is. But the pattern is because each small upgrade establishes a new baseline. And then the next upgrade is measured against that new baseline, not against where you started 5 years later. You might be spending 3 times what you used to spend, while feeling like you are living roughly the same life, just with slightly better versions of everything. And this is the danger of lifestyle creep. It consumes the additional income before you even notice you had additional income. The raises come and the raises go, and you never quite feel like you are getting ahead, because ahead keeps moving. And the truly insidious thing is that lifestyle creep rarely increases happiness in proportion to its costs. There is extensive research showing that people adapt quickly to improve circumstances, a phenomenon called hedonic adaptation. The nicer car is exciting for a few months, and then it is just your car. The bigger house is thrilling for a season, and then it is just where you live. You have spent more, but you have not felt more. And the spending has become embedded in your expectations, making it psychologically difficult to reverse. People who understand this pattern deliberately hold their lifestyle constant when their income increases. They get a raise and they continue living exactly as they did before, directing the entire increase towards savings or investments. They might do this for years, watching the gap between earning and spending grow wider and wider, until they reach a point where the investment income could cover their modest lifestyle entirely. And then they are free, not because they earned the most, but because they kept the difference between what they earned and what they spent. Topic: The hedonic treadmill of money. There is a psychological reality about money that the wealthy understand and the striving often do not, which is that the satisfaction from financial improvements is almost always temporary. You receive a raise, and for a few weeks you feel relief or excitement or pride, and then you simply feel normal again. But at a higher level of spending, your new income is just your income, and you begin wanting more. This is the hedonic treadmill, and it applies to money just as powerfully as it applies to any other source of pleasure. Your expectations adjust upward to match your circumstances, and once they have adjusted, the circumstances no longer provide the boost they initially provided. The person earning $100,000 feels exactly as stressed about money as they felt when they earned $50,000. Because their expectations and lifestyle have expanded to fill the space. And this creates a strange situation where more is never enough. Because the goal keeps moving, what would have seemed like unimaginable wealth to your younger self becomes merely adequate to your current self. And this is not because you have become greedy or ungrateful. It is simply how human psychology works. We are built to adapt to circumstances and to continue striving regardless of what we have already achieved, which was probably useful on the savannah where complacency might have been dangerous, but is exhausting in modern economies, where there is always another rung on the ladder. Always another level of wealth to aspire to. The escape from this treadmill is not more money, it is different relationship with money. Specifically, it is learning to find satisfaction in sufficiency rather than an increase. It is understanding that the boost you feel from more will fade, and arranging your life so that you do not depend on constantly achieving more. To feel okay, this is much harder than it sounds, because the entire economy is organized around making you want more. And because the treadmill is not something you can see while you are running on it, it feels like genuine progress, right up until the moment you stop and realize you have been running in place. Topic: Money scripts. Deep in your mind, there are beliefs about money that you probably did not choose, and may not even be fully aware of beliefs that were installed during childhood, through observation and osmosis and offhand comments from the adults around you. Psychologists call these money scripts, and they exert enormous influence over your financial behavior, often without your conscious knowledge. A money script might be something like money is the root of all evil, or rich people are greedy, or you have to work hard for money, or there will never be enough, or money is love, or money solves all problems. These scripts form early. They form from watching how your parents handled money, from the things they said when bills arrived, from whether abundance or scarcity was the background assumption of your household, from how money was used as reward or punishment or control. And once formed, they operate below the surface of consciousness, shaping decisions in ways you cannot easily trace. Someone with a script that says money is evil might unconsciously sabotage their own earning potential, because deep down, they do not want to become the kind of person. They learn to despise someone with a script that says there will never be enough. Might hoard compulsively, unable to enjoy what they have, because they are always bracing for loss. Someone with a script that says money means love might spend lavishly on others, trying to buy the affection they crave, or might feel unloved when their partner does not provide financially, even if their partner shows love in countless other ways. The first step in changing your financial life is often identifying these scripts, bringing them from the unconscious into awareness, where they can be examined and questioned and sometimes revised, because a belief you absorbed at age 6 is not necessarily a belief that serves you at age 40, but you cannot revise a belief you do not know you hold. Topic: Systems over labor. One of the fundamental differences between how wealthy people think and how most people think is the distinction between working in a system and working on a system. Most people trade their time for money directly. They show up, they perform tasks, they receive payment, and when they stop showing up, the payment stops. This is working in a system, and there is nothing wrong with it, but it has a natural ceiling because there are only so many hours in a day, and only so much value any individual can create through direct labor. Wealthy people tend to focus instead on building systems that generate value. Whether or not they are personally present, a system might be a business that runs without them, or a piece of intellectual property that continues to earn royalties, or an investment portfolio that compounds on its own, or a process they have designed that others execute. The key characteristic is that the value creation has been separated from their personal time, which means it can scale in ways that direct labor cannot. And this is not just about working smarter instead of harder. Although that is part of it, it is about a fundamental shift in perspective from being a producer to being an owner. When you are a producer, your income depends on your production, and your production depends on your presence. When you are an owner, your income depends on the production of systems you own, and those systems can produce without you. The transition from producer to owner is one of the most difficult shifts to make because it often requires accepting less money in the short term. In order to build something that generates more money in the long term, it requires thinking in terms of years rather than weeks, and it requires a kind of faith that the system you are building will eventually work, even when the immediate returns seem paltry compared to what you could earn by simply selling your time directly. But for those who make this transition, the calculus of life changes fundamentally because they have broken the link between hours and income. Topic: Opportunity cost. Blindness. Every financial decision is actually two decisions: the thing you choose to do and the thing you choose not to do. When you spend $20, you are not just acquiring whatever you bought. You are also giving up everything else that $20 could have become. And this includes not just other purchases, but future wealth, because money invested compounds over time. And money spent is money that will never compound. Most people are almost entirely blind to this second decision, the opportunity cost. They see what they are getting, but they do not see what they are giving up. And this blindness distorts their choices in profound ways. Consider a purchase that costs $100 that seems straightforward enough. But if that $100 were invested instead and earned a 7% annual return over 30 years, it would grow to about $760. So the true cost of that purchase is not $100, it is $760 in future wealth. You will now never have. This does not mean you should never spend money. The purpose of money is ultimately to be used, but it does mean you should make spending decisions with full awareness of what you are actually trading away. The coffee shop where you spend $5 3 times a week is not costing you $15 per week. It is costing you roughly $200,000 over a 40-year career. Once you account for the investment returns you are forgoing. This is not an argument that you should never buy coffee. It is an argument that you should buy the coffee knowing what it actually costs and deciding consciously that the coffee is worth it to you. Wealthy people tend to be acutely aware of opportunity costs, which is why they often seem irrationally cheap about small things that do not matter to them while spending freely on things that do. They are not being inconsistent. They are simply making choices based on full cost accounting, while others make choices based on sticker price alone. Hot topic. High earners who die broke. There is a phenomenon that seems impossible until you understand it. People who earn millions of dollars over their lifetimes and end up with nothing. Athletes, entertainers, executives, lottery winners, inheritors, people who had more money flow through their hands than most people ever see, and yet somehow finished broke. This happens far more often than you might think, and it reveals something important about the nature of wealth, which is that earning money and keeping money are completely different skills. And the second is actually more important than the first. The person who earns $50,000 a year and keeps 10% will ultimately become wealthier than the person who earns $500,000 a year and keeps nothing, because wealth is not about income. It is about the difference between income and spending. The high earner who spends everything has no wealth, regardless of how impressive their tax return looks, while the modest earner who consistently saves has wealth growing every year. The psychology of high income often works against keeping money because when you earn a lot, you feel like you can afford anything. And so you often try to afford everything. There is also social pressure to display your success, to live in a manner befitting your income, to show the world that you have made it. And this display is expensive. And the cycle of earning and displaying can consume every dollar that comes in, leaving nothing behind when the income eventually stops, whether through retirement or job loss, or simply the fading of whatever brought the money in the first place. The high earner who spent everything discovers they have built nothing, and the high income that once seemed like a guarantee of financial security turns out to have been just a means of financing a lifestyle that now has to end abruptly and painfully, while the person who never earned much, but always kept something, has quietly built a fortress that will protect them for the rest of their lives. Topic: the compound curve. There is a mathematical force operating in finance that is so powerful and so counterintuitive that even people who understand it intellectually often fail to appreciate it emotionally, and that force is compound growth. The idea is simple: your money earns returns, and then those returns earn returns, and then those returns on returns earn their own returns. And this process continues indefinitely, with each layer building on all the layers that came before. What makes it counterintuitive is that the growth is slow and almost imperceptible at first, and then suddenly explosive at the end. The classic example is the lily pad that doubles in size each day and covers half the pond on day 29, and the whole pond on day 30. The pond was almost empty for most of the month, and then it was half full, and then it was completely full in a single day. This is how compound growth works. The curve is nearly flat for a long time, and then it goes vertical, and most people give up somewhere on the flat part because it does not look like anything is happening. They contribute to their retirement account for 5 years, and their balance is not that different from what they put in, and they conclude that investing does not really work for them, and they stop, and they miss everything because everything happens at the end. Someone who invests consistently from age 25 to 65 will find that the money they contributed in their 20s dwarfs everything that came after, because it had the longest time to compound. Their $30,000 from their 20s might become $500,000, while their $30,000 from their 50s might barely grow at all, because time is the essential ingredient, and the compounding curve is essentially a machine for converting time into money for those patient enough to let it run. But that patience is incredibly rare because we are wired for immediate results, and the compound curve delivers its results in a lump sum at the end after decades of apparent nothing. Hot topic: the myth of self-made. The phrase self-made millionaire or self-made billionaire implies that wealth was created through individual effort alone, that someone started from zero, and through their own brilliance and hard work accumulated everything they have. And while individual effort certainly matters, the idea that anyone is truly self-made is a mythology that obscures the many forms of help and advantage that make wealth accumulation possible. Every wealthy person benefited from infrastructure they did not build, from education systems that developed their skills, from legal frameworks that protect property rights from stable currencies, that store value from employees whose labor created surplus value from customers, whose purchases provided revenue from investors, whose capital enabled growth from family members, who provided early support from mentors, who shared knowledge from luck and timing and circumstance and opportunity. This is not to diminish the role of talent and effort; those matter greatly, but they matter in context, and that context is never created by the individual alone. The mythology of the self-made person serves a purpose in society. It suggests that anyone who works hard enough can achieve the same results, and therefore that those who have not achieved such results simply did not work hard enough. This is convenient for those who have succeeded, because it justifies their success as purely earned, and for those who have not succeeded, because it suggests the solution is simply more effort, but it is not accurate. It mistakes a necessary condition for a sufficient one. Yes, hard work is necessary for wealth, but it is not sufficient, and pretending otherwise makes it harder to understand how wealth actually works and what actually increases the probability of achieving it. Understanding that no one is self-made does not diminish the accomplishment of building wealth. It actually makes it clear what is required, because if you know that context matters, you can try to improve your context. And if you know that help matters, you can seek help rather than struggling alone under the delusion that assistance would somehow taint your eventual success. Topic: the power of no. There is a word that wealthy people use far more often than most people realize, and that word is no. They say no to investment opportunities that do not fit their criteria. They say no to social obligations that would consume their time. They say no to purchases that do not align with their values. They say no to requests for their attention from people who would waste it. And this constant saying of no is not selfishness or miserliness. It is recognition that every yes is also a no to something else. When you say yes to this purchase, you are saying no to the future wealth that money could have become. When you say yes to this meeting, you are saying no to whatever else you could have done with that hour. When you say yes to this obligation, you are saying no to the freedom of having an open calendar. The wealthy understand that their resources, whether money or time or attention, are finite, and that protecting those resources requires active defense against the endless claims the world will make upon them. Most people default to yes because no feels uncomfortable. It feels like rejection or rudeness or missing out. But defaulting to yes means your resources get allocated by whoever happens to ask, rather than by your own priorities. It means you accumulate obligations and expenses and commitments until you feel trapped by your own agreements. And this is how people end up with closets full of things they never use, calendars full of events they do not enjoy, portfolios full of investments they do not understand because they said yes reflexively, without stopping to ask whether this particular yes was worth the no. It implied learning to say no and to say it without excessive explanation or apology is one of the most powerful wealth-building skills you can develop because it preserves the resources that make wealth possible. Topic: Sunk cost enslavement. There is a cognitive trap that keeps people stuck in bad financial situations long after they should have escaped, and it is called the sunk cost fallacy, which works like this. You have already invested money or time or effort into something, and that investment is gone. It cannot be recovered, but because you have invested it, you feel compelled to continue, even when continuing makes no sense, because walking away would mean admitting that the original investment was wasted. You stay in the degree program you hate because you have already completed 2 years, and you cannot bear to think those 2 years were wasted. So you waste 2 more. You keep the car that constantly breaks down because you have already spent so much on repairs that you cannot bring yourself to sell it. So you spend more on repairs. You hold the investment that keeps declining because you bought it at a higher price and selling now would mean realizing the loss. So you hold it while it falls further. The wealthy understand that sunk costs are irrelevant to decisions about the future. The money is gone, whether you continue or not. The time is gone, whether you persist or not. The only question that matters is, what is the best use of your resources from this moment forward? Not what you did with resources in the past. This is emotionally difficult because it requires accepting loss. It requires saying, yes, I made a mistake, and that mistake cost me, and I cannot get that cost back. And now I am going to make the best decision I can from here, rather than compounding the original mistake with additional mistakes. But this acceptance is liberating because it frees you from the weight of past decisions. It lets you ask clearly, without the distortion of prior investment, what should I do now? And people who can ask that question cleanly make better decisions than people who are dragging along the psychological weight of everything they have already spent. Topic: The Wealth Thermostat. There is a concept in psychology called the financial thermostat, or wealth thermostat, and it describes the strange phenomenon where people seem to have an unconscious set point for how much money they feel comfortable having. When they fall below this set point, they work harder, spend less, and find ways to get back up to it. But when they rise above this set point, they unconsciously sabotage themselves. They make bad investments, they spend extravagantly. They find ways to shed the excess and return to the level where they feel they belong. This is why lottery winners so often end up broke within a few years, and why people who lose everything often rebuild to roughly the same level they had before. Their unconscious thermostat keeps pulling them back to their set point, regardless of external circumstances. The set point is usually established in childhood, based on what level of wealth felt normal in your family of origin. If you grew up in a household that struggled with money, your thermostat might be set low, and you might unconsciously undermine yourself whenever you start to accumulate more than feels familiar. If you grew up in a household of abundance, your thermostat might be set high, and you might feel an uncomfortable compulsion to restore that level of abundance whenever you fall below it. The first step in changing your thermostat is recognizing that it exists, becoming aware of your own patterns of self-sabotage or self-limitation, and asking where these patterns came from. The second step is gradually exposing yourself to different levels of wealth, not just intellectually but emotionally, letting yourself sit with the discomfort of having more than feels normal until more starts to feel normal, allowing your set point to adjust upward. This is slow work because the thermostat was calibrated over years, and it cannot be reset overnight, but it can be reset. And for many people, adjusting this unconscious set point matters more than any external financial strategy, because without that adjustment, any gains will be temporary and any losses will feel inevitable. Topic: Rich Dad timing. One of the least discussed advantages in wealth accumulation is simply the timing of when you learn certain things about money. Someone who learns about compound growth at age 15 has a massive advantage over someone who learns about it at age 45. Not because the knowledge is different, but because they have 30 extra years to apply it. Someone who learns about tax-advantaged accounts in their early 20s can capture decades of tax-free growth that someone who learns later can never recapture. And this creates a generational effect, where children of financially sophisticated parents receive not just money, but something more valuable, which is knowledge delivered at the optimal time to use it. They learn about investing before they have income to invest, so they are ready when the income arrives. They learn about debt before they have access to credit, so they can evaluate credit offers clearly, rather than being seduced by them. They learn about lifestyle inflation before they experience their first raise, so they can consciously choose their spending level, rather than drifting upward automatically. This timing advantage compounds just like money does, because good financial decisions made early create resources that enable more good decisions. And the person who started learning early is always playing the game, several moves ahead of the person who started late. None of this is fair, and none of it is the fault of those who learn late. Many people received no financial education at all, and had to learn everything the hard way through mistakes that cost them years of progress. But understanding that timing matters can at least motivate you to ensure the next generation learns earlier than you did, and can help you forgive yourself for mistakes that stemmed not from stupidity, but simply from not knowing what you had not yet been taught. Topic: status games and real wealth. There are two different games being played with money, and most people do not realize they are playing both simultaneously, or that the games have opposite rules. The first game is the wealth game, where the goal is to accumulate resources that provide security and options and freedom. The second game is the status game, where the goal is to signal your position in the social hierarchy, to demonstrate that you are successful, that you matter, that you have made it. These games use the same currency, but they have opposite mechanics. In the wealth game, you win by keeping money, by accumulating it, by making it grow. In the status game, you win by spending money, by displaying it, by converting it into visible signals that others can observe and admire. And this is why so many high earners stay stuck. They are winning the status game while losing the wealth game. They have the admiration of their peers. They have the visible markers of success. They have the lifestyle that signals arrival, but they have no accumulated wealth, no financial freedom, no security against future disruptions, because everything they earned went into the status competition. The wealthy people who actually have wealth have usually found a way to exit the status game, or at least to play it very selectively. They have decided that the opinion of others is not worth the cost of signaling. They have found their status in accomplishment or contribution rather than in consumption. They have surrounded themselves with people who do not judge worth by visible display. And this is harder than it sounds, because the status game is wired into us. Deeply, humans are social creatures, and social creatures care about their position in the group. But it is possible to consciously choose which status games you play and which currencies they use. And the choice to opt out of consumption-based status competition is one of the most important financial decisions you can make. Topic: the boring investment secret. If there is one secret about investing that the financial industry desperately does not want you to know, it is that the most reliable path to investment success is almost unbearably boring. You buy a diversified portfolio of low-cost index funds, and then you do nothing. You do not watch financial news. You do not react to market movements. You do not try to time your entry or exit. You do not search for the next hot stock or sector. You simply buy regularly, regardless of conditions, and hold essentially forever. This approach beats most professional money managers over the long term, which sounds impossible until you understand why it works. First, most market movements are noise, not signal, and reacting to noise by trading generates costs and taxes that compound against you. Second, nobody can reliably predict which investments will outperform, which means attempts to pick winners mostly just add expense and risk. Third, the professionals have the same information you do, and they are competing against each other, which means their collective efforts cancel out, leaving them at roughly market returns minus their fees. So by simply buying the market, you get market returns minus minimal fees, which beats most active strategies most of the time. The reason this secret persists despite being well known is that it is psychologically almost impossible to follow. It requires doing nothing during periods of market panic, when everything in you screams to sell it, requires doing nothing during periods of market euphoria, when everything in you screams to buy more of whatever is going up. It requires accepting that you will never beat the market, while also accepting that you do not need to beat the market to achieve your goals. It requires tolerating the boredom of a strategy that offers nothing to talk about at parties. No clever trades, no prescient calls, no exciting stories, just steady automatic contributions to a portfolio you barely look at. And this boredom is too much for most people. They add complexity because complexity feels like sophistication. They trade because trading feels like doing something, and the doing something costs them enormously, while the doing nothing would have made them wealthy. Topic: Why millionaires ignore their portfolios. There is a pattern among people who have built substantial wealth through investing, and it is that they almost never check their accounts. You might expect the opposite, that people with millions at stake would monitor their investments obsessively. But the opposite is true, and this is not negligence. It is wisdom. Every time you check your portfolio, you create an opportunity for emotional reaction, and emotional reaction is the enemy of long-term returns. If you check daily, you will see losses roughly half the time, because day-to-day market movements are essentially random, and each loss creates a small psychological wound that accumulates over time, making you more likely to eventually do something foolish, like selling in a panic. If you check weekly, you will still see losses often enough to feel unstable. If you check monthly, the picture smooths somewhat, and if you check yearly or even less frequently, you mostly just see the long-term upward trend that has characterized markets throughout history. The wealthy investor who checks once a year sees their wealth growing steadily. The anxious investor who checks daily sees chaos and noise and cannot help but react to it. There is research showing that investors who receive more frequent account statements actually earn lower returns. Not because the statements change their investments, but because the statements change their behavior. The constant updates create constant anxiety, which creates constant temptation to tinker, and the tinkering destroys value. So the millionaire who ignores their portfolio is not being cavalier. They are being strategic. They have set up a system they trust, and then they have removed themselves from the system. So their emotional responses cannot interfere with its operation. They have recognized that the greatest risk to their wealth is not the market but themselves, and they have structured their information environment to protect against that risk. Topic: Debt as a tool. The relationship between debt and wealth is more complicated than most people understand, because debt is not inherently good or bad. It is a tool, and like any tool, it can be used skillfully or clumsily, productively or destructively. The conventional wisdom that all debt is bad and you should pay it off as quickly as possible is too simple, because it ignores the distinction between debt that costs you money and debt that makes you money if you borrow at 5% to invest in something that returns 15%. The debt is making you wealthier, not poorer every month. You carry that debt, you come out ahead. This is how real estate investors operate. They use other people's money to buy assets that generate returns greater than the cost of borrowing, and the spread between the cost and the return multiplies their wealth faster than they could ever multiply it. Using only their own capital, this is called leverage, and used wisely. It is one of the most powerful wealth-building tools available, but leverage is a double-edged blade, because it amplifies both gains and losses. If you borrow to invest and the investment goes down, you lose more than you would have lost with your own money, and you still owe the debt, which is how people get wiped out. The skill is in knowing which debt to take on and which to avoid. Consumer debt for things that depreciate is almost always destructive. You are paying interest on assets that are losing value, which means you are accelerating your own impoverishment debt. For education depends entirely on what the education provides. If it opens doors to higher earning, the debt may be worthwhile, and if it does not, the debt is just a burden debt for appreciating assets like real estate, or a business can be wealth building. If the assets are well chosen and the terms are manageable, the wealthy tend to be comfortable with debt in a way that makes the debt averse uncomfortable, because they see it as a tool to be used strategically, rather than a moral failing to be avoided at all costs. Topic: The tax code as a map. There is a document that reveals exactly what the government wants you to do with your money, and that document is the tax code. It is not written to be fair or simple. It is written to incentivize specific behaviors. And if you read it as a map, it tells you where the paths of least resistance are. The government wants you to save for retirement, so there are enormous tax advantages to retirement accounts. The government wants you to own a home, so there are deductions for mortgage interest. The government wants you to start businesses, so there are deductions for business expenses. The government wants you to invest in certain areas, so there are credits and incentives for those investments. The wealthy understand that taxes are not just a cost to be minimized, but a signal to be read. They arrange their affairs to take advantage of the incentives the code provides, not through anything illegal, but simply by doing the things the code rewards. They hold investments long enough to qualify for lower long-term capital gains rates. They maximize contributions to tax-advantaged accounts. They structure income to flow through entities that receive favorable treatment. They time realizations to smooth tax liability across years, and the cumulative effect of these choices is enormous over a lifetime. Someone who pays attention to the tax code will keep vastly more of their earnings than someone who ignores it, even if their gross income is identical. This is not about cheating. It is about understanding that the rules are not neutral and playing by the rules as they actually exist, rather than as you might think they should exist. The middle class tends to pay taxes as an afterthought, something calculated once a year when returns are filed. The wealthy tend to think about taxes constantly as a factor in every financial decision, because they understand that the after-tax return is the only return that matters. Topic: multiple income streams. If you study people who have achieved financial independence, you will find that almost none of them rely on a single source of income. They have multiple streams, some active and some passive, some from labor and some from capital, some reliable and some variable. And this diversification is not accidental. It is strategic, because depending on a single income source creates fragility. When that source fails, everything fails. The employee with one job is devastated by a layoff. The business owner with one product is devastated by a market shift. The investor with one asset class is devastated by a crash. But the person with multiple income streams experiences these disruptions as setbacks rather than catastrophes. One stream fails, and the others continue providing time and resources to rebuild or replace the failed stream. There is also a compounding effect to multiple streams. Once you have established one source of income and systematized it, so it runs without constant attention, you have freed up capacity to build another. And once you have two, you can build a third, and each new stream adds both income and security. The wealthy often describe a point where income streams start generating new income streams. Almost automatically, the rental property cash flow gets invested in index funds, which generate dividends, which get reinvested, and the entire system grows without much additional effort. This is very different from the traditional model of trading time for a single paycheck, and it requires thinking differently about what income even is not a payment for showing up, but a return on assets. You own assets that might be financial or might be intellectual property, or might be relationships or reputation or skill or attention, whatever form they take. The goal is accumulating assets that generate returns independent of your daily presence. Topic: risk tolerance, mismatch. One of the most common financial mistakes is investing in a way that does not match your actual psychological risk tolerance. And this mistake happens in both directions. Some people invest too conservatively, keeping everything in savings accounts and bonds because they cannot stomach volatility, and they pay for this comfort through lower returns that leave them poorer in the long run. Others invest too aggressively, putting everything into high-risk assets because they are intellectually convinced they can handle volatility. And then when the volatility actually arrives, they panic and sell at the worst possible time, locking in losses that devastate their wealth. The problem is that most people do not actually know their risk tolerance until it is tested. It is easy to say you will stay calm during a 50% market decline when you have never experienced one. It is easy to believe you will hold through the panic when you have only seen markets go up, and so people construct portfolios based on how they imagine they will behave rather than how they actually behave. And then they discover the hard way that their imagination was wrong. The wealthy tend to be more realistic about this. They have often lived through enough market cycles to know their actual reactions, and they construct portfolios. They can actually hold through turbulence, even if those portfolios are theoretically suboptimal. They understand that the perfect portfolio you cannot stick with is worse than the imperfect portfolio you can. And they make their peace with leaving some theoretical returns on the table in exchange for being able to sleep at night and not destroying their wealth through panic selling. The right portfolio is not the one with the highest expected return. It is the one that aligns your investments with your actual psychology so that you can stay the course when staying the course is hardest. Topic: the 10-year overnight success. When someone achieves visible financial success, it often looks sudden from the outside. One day they were unknown and struggling, and the next day they were wealthy and celebrated. But this appearance is almost always an illusion, because what you see is the moment of visibility, not the years of invisible work that preceded it. The entrepreneur whose company just sold for millions spent a decade building skills and relationships and making failed attempts that no one noticed. The investor who seems to have impeccable timing has been studying and practicing and losing money on bad ideas for years before the good ideas started working. The creator whose content went viral produced hundreds of pieces that went nowhere before the algorithm finally blessed them. This pattern is so consistent that it has a name: the 10-year overnight success. And understanding it changes how you think about your own timeline. Because if you are in year 3 of building something and it does not seem to be working yet, you might be exactly on track. You might be in the long invisible period that precedes the visible success. And if you give up now, you will never reach the inflection point where everything changes. The wealthy often describe periods of their lives that looked from the inside like failure years, when nothing seemed to work, when progress was imperceptible, when they questioned whether they were wasting their time. And they describe how those periods were actually essential, because they were building the foundation that eventually supported everything that came later. The lesson is not that success is guaranteed if you persist long enough. Sometimes things genuinely do not work and should be abandoned. But the lesson is that success is almost never fast. And if you are expecting fast, you will quit before you reach the point where slow efforts compound into something meaningful. Topic: social capital currency. There is a form of wealth that does not appear on any balance sheet, but that often matters more than financial wealth. And that is social capital, the network of relationships and reputation and trust that you have built over time. Social capital can be converted into financial capital in ways that are indirect but powerful. The job you get because someone recommended you the investment opportunity you hear about. Because you are in the right room, the partnership you form. Because someone vouches for you, the customer you acquire. Because you were referred, these conversions happen constantly, and they happen more for people with more social capital. The wealthy understand this, and they invest. In relationships with the same intentionality, they invest in financial assets. They maintain connections even when there is no immediate benefit. They help others without expecting immediate reciprocity. They build reputations for reliability and competence and generosity, and these investments pay returns for decades. But social capital has different properties than financial capital. It cannot be hoarded because relationships require ongoing maintenance. It cannot be extracted aggressively because people sense when they are being used and withdraw their trust. It grows through genuine contribution, not through strategic manipulation. The people with the most social capital are usually not the ones calculating how to maximize it. They are the ones who genuinely enjoy connecting with others and helping where they can. And their social wealth grows as a byproduct of who they are, rather than as a product of strategic networking. The lesson is not to be more calculating about relationships, but to recognize that generosity and connection have returns that extend far beyond the immediate moment, and that the most valuable currency is often not money, but the trust and goodwill of people who know you well. Topic: the hidden cost of cheap things. There is an allure to getting things cheap that runs deep in human psychology. The satisfaction of a bargain, the pride of saving money, the sense that you have beaten the system somehow. And this instinct serves well when it leads to genuine value, when you find quality at a lower price than others pay. But it can also mislead when it causes you to buy cheap things that are not actually cheaper. Once you account for their true costs, the cheap tool that breaks and must be replaced costs more than the quality tool that lasts 20 years. The cheap shoes that wear out in months and hurt your feet and look shabby cost more than the good shoes that last years. and remain comfortable the cheap service provider who does the job poorly and creates problems you have to fix costs more than the expensive provider who does it right. The first time, this is not an argument for always buying the most expensive option. Quality and price are not perfectly correlated, and expensive things can be overpriced, just as cheap things can be bargains. But it is an argument for thinking about total cost of ownership, rather than purchase price, for considering how long something will last, and how much maintenance it will require, and how well it will perform its function over time. The wealthy tend to buy quality and things that matter to them, and they are surprisingly indifferent to price when quality is at stake, because they have learned that cheap often means expensive. In the long run, they would rather pay once for something good than pay repeatedly for something that keeps failing. And this is how they end up with possessions that last for decades, while others cycle through endless replacements, spending more in total while always feeling like they cannot afford. The good version topic: asset acquisition mindset. There is a fundamental difference in how people think about money that separates those who build wealth from those who do not. And it comes down to one question when money comes in. What do you do with it? Most people think in terms of consumption. Money arrives, and they consider what they can buy, what experience they can have, what desire they can satisfy. The wealthy tend to think in terms of acquisition, not of things but of assets. Money arrives, and they consider what income-producing or appreciating asset they can add to their collection, what machine they can buy that will generate more money. An asset is anything that puts money in your pocket over time. It might be a stock that pays dividends, or a bond that pays interest, or a property that pays rent, or a business that generates profits, or intellectual property that earns royalties. The specific form matters less than the fundamental characteristic that it generates. Returns. The consumption mindset sees money as potential enjoyment. The asset mindset sees money as potential future money. And this difference in framing leads to completely different behaviors over time. The consumer enjoys their money now and has nothing tomorrow. The asset acquirer defers enjoyment to build a collection of assets that eventually generates enough income to fund enjoyment forever, without depleting the principal. This is not about deprivation. The wealthy are not miserable ascetics who never enjoy anything, but they tend to acquire assets first and consume second, using the income from their assets to fund their consumption rather than consuming the principal itself. And this ordering makes all the difference, because income can be spent repeatedly, while principal can only be spent once. Topic: inflation as silent theft. There is a force that is constantly eroding your wealth, and unless you understand it, you will not know to defend against it. That force is inflation, the slow, steady decline in the purchasing power of money. $1 today will buy less than $1 bought a year ago, and far less than it bought a decade ago. And this erosion happens so gradually that it is almost invisible day to day. But over a lifetime, it transforms what feels like security into something close to poverty. The person who proudly keeps their money safe in a savings account, earning 1% interest while inflation runs at 3%, is not keeping their money safe. They are losing 2% of its real value every year after 20 years. They will have roughly 40% less purchasing power than they started with, even though the nominal number in their account has grown. This is why holding too much cash is actually risky. Even though it feels safe, you are guaranteed to lose value slowly, rather than risking losing value quickly and for long time horizons. The guaranteed slow loss often costs more than the possible fast loss. Would have the wealthy understand this, which is why they keep relatively little of their wealth in cash. They hold enough for near-term needs and emergencies, but the rest goes into assets that have historically outpaced inflation. Equities, real estate, commodities, things that tend to rise in price along with or faster than the general price level. This is not because they are greedy for returns. It is because they understand that cash is not a safe haven, but a melting ice cube, and that the only way to preserve wealth over time is to invest it in things that grow faster than money loses its value. Topic: the true cost of cars. Of all the ways people accidentally impoverish themselves, automobile purchases may be the most significant, because cars combine several wealth-destroying features in one package. They are expensive, they depreciate rapidly, They require ongoing costs for insurance and maintenance and fuel, and they must eventually be replaced. And yet people consistently spend more on cars than they can reasonably afford, often financing them with loans that add interest costs on top of everything else. Consider what happens when you buy a $40,000 car with a loan at 7% interest over 5 years. You will pay about $47,000 total. By the time the loan is finished, the car will be worth perhaps $15,000. You have spent $47,000 to have an asset worth $15,000. And over those 5 years, you have also paid for insurance, gas, maintenance, parking, and all the other costs of car ownership. The total cost of operating a car over 5 years often exceeds the purchase price of the car itself. The wealthy are often remarkably indifferent to cars, which seems strange until you realize they are simply doing the math. They understand that a car is transportation, not an investment, and they buy the least expensive car that meets their transportation needs rather than the most expensive car. They can qualify to finance. They drive cars for 10 years instead of trading up every 3. They buy used rather than new, letting someone else absorb the steepest depreciation. They view car expenses as a budget category to minimize, rather than a status symbol to maximize. And the savings from this approach over a lifetime are enormous, because every dollar not spent on car depreciation and interest is a dollar that can compound for decades. Topic: Housing consumption versus investment. There is a persistent myth that buying a house is automatically a good investment, and this myth has led many people to make housing decisions that damage their wealth. Because while houses can be investments, they can also be consumption disguised as investment, and the difference matters enormously. A house is an investment when it generates returns, either through rental income or through appreciation, that exceeds the cost of ownership. A house is consumption when you live in it, and it costs more than the alternative would have cost, which is often the case once you account for all the expenses that homeownership involves: mortgage, interest, property taxes, insurance, maintenance, repairs, homeowner association fees, opportunity cost on the down payment, and the transaction costs of buying and selling. The myth persists because people compare their mortgage payment to rent and conclude that owning is better since they are building equity. But this comparison leaves out most of the costs, and it ignores that the renter could invest the down payment and the difference between rent and total ownership costs, and that investment might grow faster than home equity. The wealthy understand that there is a difference between a home you live in and real estate as an investment. A home is a place you inhabit, and its financial return is secondary to its utility as shelter. Real estate investment is about generating returns, and the properties that generate the best returns are often not the ones you would want to live in. Your self-conflating these two categories leads to buying more house than you need and justifying it as an investment, when it is actually consumption, and the consumption is fine if you can afford it and choose it consciously. But calling it investment does not make it so. Topic: Income versus wealth. Confusion. There is a fundamental confusion that pervades how most people think about money, and it is the confusion between income and wealth. These are not the same thing, and treating them as interchangeable leads to serious errors in financial thinking. Income is what flows in the money you receive from work or investments or other sources. Wealth is what accumulates the money you keep and grow over time. You can have high income and no wealth if you spend everything you earn, and you can have modest income and substantial wealth if you consistently spend less than you earn and invest the difference. The doctor earning $400,000 a year, who spends $400,000 a year, has no more wealth than the teacher earning $50,000, who also spends everything. They are both at zero, despite the eightfold difference in income. But the teacher earning $50,000 who saves $10,000 a year is building wealth, while the doctor who saves nothing is not. And over time, the teacher will surpass the doctor in actual financial security, even though they will never match them in income. This confusion is reinforced by how we talk about money. We describe people as making a lot of money when we mean they have high income. We assume that high earners are wealthy and that modest earners are not. We use income as a proxy for financial success, when wealth is the actual measure of financial security. The wealthy understand this distinction viscerally. They know people with enormous incomes who are financially fragile and people with modest incomes who are financially secure. They measure their own progress by net worth, not by salary, and they make decisions based on how those decisions affect their wealth, not just their income. This shift in focus from income to wealth changes everything, because once you understand that wealth is what matters, you start optimizing for wealth rather than for the income that may or may not become wealth. Topic: the savings rate. Truth: if there is one number that predicts financial outcomes more reliably than any other, it is the savings rate, the percentage of income that is not consumed but retained and invested for the future. This number matters more than income because it determines how much of what flows in actually stays. It matters more than investment returns because even mediocre returns on a high savings rate will outperform excellent returns on no savings. And it has a double effect on financial independence because every dollar saved both adds to your wealth and subtracts from the expenses that wealth must eventually cover. Consider two people with identical incomes. One saves 10% and spends 90%. The other saves 50% and spends 50%. The high saver is not just accumulating wealth 5 times faster. They are also building toward a lifestyle that costs half as much to maintain, which means they need to accumulate far less to achieve independence. The person saving 50% of their income might reach financial independence in 15 years, while the person saving 10% might need 40 years or more. Even with identical incomes and identical investment returns, the savings rate is that powerful. And yet most people have no idea what their savings rate is. They have never calculated it. They focus on income or on investment performance or on individual expenses, but not on the fundamental ratio that determines their trajectory. The wealthy tend to know their savings rate precisely and to treat it as the primary metric of financial health. They might accept a lower income for a higher quality of life. They might accept lower investment returns for lower volatility, but they protect their savings rate because they understand it is the foundation on which everything else is built. Topic: automation and friction. There is a principle from behavioral economics that has profound implications for building wealth, and it is that small amounts of friction can dramatically change behavior even when the underlying costs and benefits remain the same. If something is slightly harder to do, people do less of it. If something is slightly easier to do, people do more of it, and this asymmetry can be exploited to build systems that make wealth accumulation automatic and wealth destruction difficult. The most obvious application is automatic savings. If money moves from your paycheck to savings before you ever see it, you will save without effort or willpower, because the friction of transferring it back is enough to prevent casual spending. The money is technically still available, but the small barrier of having to access it changes your behavior. The same principle works in reverse for spending. If you have to enter your credit card number manually, for each purchase, you will buy less than if the number is stored, and purchasing is one click. The friction is tiny, but it changes outcomes. The wealthy often describe their financial lives as heavily automated, not because they are lazy, but because they understand that systems beat willpower every time they have arranged automatic transfers to savings, automatic investments, automatic bill payments, so that the right financial behaviors happen without requiring decisions. They have also created friction around spending, deleting stored payment information, imposing waiting periods on purchases above certain amounts, using cash for discretionary spending. So they feel the money, leaving this combination of removing friction from good behaviors and adding friction to bad behaviors creates a financial life that trends in the right direction by default, without constant vigilance or self-control. Topic: the psychology of windfalls. When people receive unexpected money, whether from inheritance or bonus or lottery or settlement, they often handle it very differently from how they handle regular income, and this difference usually works against them. Windfalls feel like found money, like something extra outside the normal budget, and this mental categorization makes them easier to spend freely. There is extensive research showing that people are more likely to spend windfall money on luxuries and less likely to save it compared to equivalent amounts received as regular income. The categories we create in our minds affect how we treat the money. Even though money is fungible, and $1 from a windfall is worth exactly the same as $1 from a paycheck. The wealthy tend to have systems for handling windfalls that override the natural psychological tendency to spend them. They have predetermined rules. Like any unexpected money above a certain threshold goes directly to investment. They treat windfalls as acceleration of their existing plan, rather than as bonus money to be spent on treats. They recognize the psychological trap, and they design around it. The other danger of windfalls is lifestyle inflation. A one-time bonus leads to an ongoing expense because you upgrade something that now needs to be maintained at the higher level. The wealthy are particularly careful about this. They might use a windfall to pay down debt or invest or make a one-time purchase, but they are reluctant to let it permanently increase their expenses because that one-time money is now committed forever. Understanding windfall psychology helps you capture the full value of unexpected money rather than letting it slip away into spending you would not otherwise have done. Topic: Generational wealth patterns. There are patterns in how wealth moves across generations that reveal uncomfortable truths about the nature of financial advantage and disadvantage. Wealth tends to persist not just because money is inherited, but because the conditions that enable wealth creation are inherited. Children of wealthy families receive not just money, but education, connections, expectations, knowledge networks, confidence, exposure to opportunities, and assumptions about what is possible. And normal children of poor families often receive the opposite. Not just less money, but less of everything else that makes wealth accumulation possible. This creates something closer to a caste system than to the meritocracy that is often described, where your starting position strongly influences your ending position and mobility is much more limited than we like to believe. The research on intergenerational mobility shows that it takes multiple generations on average to move from the bottom of the income distribution to the middle or from the middle to the top. The escalator is slower than people think, and starting position matters more than people think. But there is also movement. Some people do rise from nothing, and some wealthy families do lose everything, and understanding what enables that movement is valuable for anyone trying to improve their own position or their children's position. The factors that seem to matter most are education, both formal and informal, and the habits and mindsets and knowledge that come with it, social capital in the form of networks and connections that open doors, and human capital in the form of skills and capabilities that generate value. The wealthy who maintain wealth across generations tend to invest heavily in these forms of capital, not just in financial assets. They understand that money alone is not enough, and that the capabilities to generate and maintain wealth matter as much as the wealth itself. Topic: The third generation curse. There is an old saying that wealth does not survive 3 generations. The first generation creates it, the second generation maintains it, and the third generation destroys it. And while this is not an absolute law, it happens often enough to warrant examination. What goes wrong? The typical pattern is this. The first generation builds wealth through hard work and sacrifice. They understand what it took to create their fortune, and they retain the habits of discipline and frugality that made accumulation possible. The second generation grows up watching this process. They see their parents work, they understand where the money came from, and while they did not create the wealth themselves, they have some connection to its origins and often some of the values that created it. The third generation grows up with wealth as a given. They never saw it created. They do not understand what it took, and they have no experience of life without it. They often lack the skills and habits that created the wealth in the first place, and they consume it as if it were infinite, which it is not. The pattern is not inevitable, but avoiding it requires deliberate effort. The wealthy families who maintain wealth across many generations tend to do specific things. They educate their children about money from an early age. They require their children to work and earn, even when it is not financially necessary. They expose their children to the realities of wealth creation and the consequences of wealth destruction. They build structures like trusts that protect assets from poor decisions, and they instill values that counteract the entitlement that easy wealth can create without these deliberate interventions. The natural tendency is for each generation to be a little less capable of maintaining what they inherited until eventually there is nothing left. Topic: Teaching children about money. The way children learn about money shapes their financial behavior for life, and most children learn about money poorly if they learn about it at all. Money is often a taboo topic in families treated as something adults handle, and children should not worry about. But this silence creates knowledge gaps that persist into adulthood and leaves children to figure out money through trial and error. Often expensive error, the wealthy tend to talk about money with their children from an early age, not in a burdensome way, but in a matter-of-fact way that normalizes financial literacy. They explain where money comes from and where it goes. They involve children in age-appropriate financial decisions. They discuss the reasoning behind family financial choices. They make the invisible visible because they understand that you cannot learn what you are never exposed to beyond conversation. There are practical experiences that teach financial concepts more effectively than any lecture. Earning money through work teaches the connection between effort and reward in a way that allowance handed out regardless of behavior does not. Saving for a desired purchase teaches delayed gratification and the relationship between waiting and getting what you want. Managing a small budget teaches trade-offs and prioritization. Making mistakes with small amounts of money teaches consequences while the stakes are low. The goal is to produce adults who are financially capable, who understand money intuitively, because they have been practicing with it for years. Not adults who are suddenly handed financial responsibility at 18, with no preparation for what that responsibility entails. Topic: the Allowance Experiment. There are different approaches to allowances, and each approach teaches different lessons about money. One approach ties allowance to chores, payment for work completed. This teaches the connection between labor and income, but it can also create problems like children refusing to help unless paid or negotiating compensation for basic household contributions. Another approach gives allowance regardless of behavior, a flat amount that is simply part of being a family member. This teaches that family provides, but it does not teach the labor-income connection, and it can create a sense of entitlement. A third approach separates money into categories, giving children a base amount and additional earning opportunities for extra work. This attempts to combine the benefits of both approaches. Some families add complexity by dividing allowance into portions that must be allocated to different purposes. Spending, saving, and giving. This teaches budgeting and trade-offs and values beyond consumption. The research on what works best is mixed because so much depends on context and implementation, but a few principles seem consistent. Children learn better from experience than from lectures, so giving them real money and real decisions teaches more than talking about hypotheticals. Starting early and gradually increasing responsibility as children mature works better than suddenly expecting financial sophistication. Allowing natural consequences for poor decisions teaches more effectively than parental rescue, though the consequences should be age-appropriate and non-catastrophic. The wealthy often experiment to find what works for their particular children, recognizing that different children respond to different approaches and that the goal is producing financially capable adults, not following any single formula. Topic: wealthy habits versus poor habits. There is research examining the daily habits of wealthy individuals compared to those of people who struggle financially, and while correlation is not causation, the patterns are striking. The wealthy are more likely to read regularly, particularly nonfiction and educational material. They are more likely to exercise and maintain their health. They are more likely to wake early and have structured morning routines. They are more likely to set goals and track progress toward them. They are more likely to network and maintain relationships strategically. They are less likely to watch television, particularly during prime time. They are less likely to gamble and less likely to rely on luck for their outcomes. The temptation is to interpret these as causes of wealth. Do these things and you will become wealthy. But it is more complicated than that. Many of these habits are easier to maintain when you have resources. It is easier to exercise when you can afford a gym membership and have time flexibility. It is easier to read when you are not working multiple jobs to survive. It is easier to network when you have access to rooms where important people gather. The relationship between habits and wealth likely runs in both directions. Some habits enable wealth accumulation, and having wealth enables certain habits. The practical implication is not that copying wealthy habits will make you wealthy. but that examining your own habits in light of this research might reveal where small changes could compound over time: the habit of reading 30 minutes a day, the habit of exercising regularly, the habit of setting and reviewing goals. These are within reach for most people, and while they guarantee nothing, they shift the probability distribution in a favorable direction. Topic: reading and net worth. There is a striking correlation between reading habits and financial outcomes. The wealthy read more than the struggling, and they read differently. They read for learning, not primarily for entertainment. They read nonfiction, particularly books about business investing, history, biography, and self-improvement. They read consistently, making it a daily habit, rather than an occasional activity. They often describe specific books that change their thinking or open their eyes to possibilities they had not considered before. This correlation makes sense when you think about what reading provides. It provides exposure to ideas you would not encounter in daily life, to strategies and frameworks and mental models that successful people have developed and shared. It provides the accumulated wisdom of people you will never meet. Condensed into a form you can absorb in a few hours, it is one of the highest leverage activities available because for a small investment of time and money, you can access insights that took someone else decades to develop. The wealthy often describe themselves as perpetual students, always learning, always adding to their knowledge. And reading is the most accessible form of ongoing education. It requires no enrollment, no credential, no permission, just the decision to pick up a book and the discipline to keep doing it. The person who reads a book a week for a decade will have read over 500 books and will have been exposed to more ideas and frameworks and strategies than most people encounter in a lifetime. And this exposure changes what seems possible and what approaches seem available, and how problems look when you encounter them. It is not that reading makes you wealthy, but that reading expands the space of what you know and what you can imagine. And from that expanded space, better decisions become possible. Topic: the network effect of wealth. There is a phenomenon where wealth tends to cluster, where the wealthy know each other and do business with each other, and share opportunities with each other in ways that accelerate wealth for everyone in the network, while excluding those outside it. This network effect operates through multiple mechanisms. Information flows through networks, so the wealthy learn about investment opportunities and business deals and strategic moves. Before others do, trust operates through networks, so the wealthy can make deals quickly with people they know and trust, rather than spending time and resources verifying strangers. Capital flows through networks, so when someone in the network needs funding, they can raise it from people they know who have capital to deploy talent. Flows through networks, so when someone in the network needs skilled people, they can recruit through connections rather than through open competition. This clustering is self-reinforcing because the benefits of being in the network attract more wealthy people, which makes the network more valuable, which attracts more wealthy people, and so on. While those outside the network find it increasingly difficult to compete with those inside it. This is not usually a conspiracy, it is simply how humans naturally organize. They prefer to work with people they know and trust, and similar wealth levels create shared experiences and interests that facilitate connection. The implications for someone seeking to build wealth are that access to these networks matters, and that gaining access requires deliberate effort. It requires providing value to people who could open doors. It requires building reputation and credibility. It requires showing up consistently in places where connections are made. And it requires patience because trust develops slowly, and network membership is earned over time, not granted instantly. Topic: luck and wealth attribution. There is a tendency among the wealthy to attribute their success primarily to skill and hard work, and to underestimate the role of luck, and among those who struggle to attribute their struggles primarily to bad luck, and to underestimate the role of their own decisions. Both tendencies are self-serving, and both are probably wrong. The truth is that wealth outcomes are determined by both luck and skill in proportions that are difficult to untangle. Luck includes when you were born, where you were born, who your parents were, what natural abilities you were given, what opportunities crossed your path, and countless other factors beyond your control skill. Includes the decisions you made, the habits you developed, the risks you took, and how you responded to the opportunities and obstacles. Luck presented, you cannot control luck, but you can control skill, and skill can somewhat compensate for bad luck and can amplify good luck. The wealthy who are most honest tend to acknowledge that luck played a substantial role in their success, that they were born at the right time in the right place with the right abilities, and that opportunities found them as much as they found opportunities. This acknowledgement does not diminish their accomplishment, because converting luck into wealth still requires skill. But it does create humility, and it changes how they think about others who have not achieved similar success. If luck matters, then those who struggle are not necessarily less skilled or hardworking. They may simply have drawn different cards from the deck. This has implications for how you think about your own situation too. Bad luck is real and should not be dismissed, but neither should it become an excuse that prevents you from exercising the skill you do control. Topic: Survivorship. Bias in success. When you read about successful people in books and articles and interviews, you are encountering a biased sample. You are hearing from the people who succeeded, but you are not hearing from the many more people who did similar things and failed. This is called survivorship bias, and it distorts what you learn from success stories. The entrepreneur whose risky bet paid off gets profiled. The many entrepreneurs who made similar bets and lost everything are forgotten. The investor who concentrated their portfolio in a stock that went up tenfold is celebrated. The many investors who concentrated their portfolios and were wiped out are invisible. The patterns you extract from success stories may not actually predict success. They may just be patterns that look good in retrospect, when you already know the ending. This does not mean success stories are useless, but it means they should be consumed skeptically. The question to ask is not just what did this person do, but how many people did similar things and did not succeed. If the success rate is low, then the strategy may not be as reliable as the story suggests, and the outcome may be attributable more to luck than to the strategy itself. The wealthy who have succeeded tend to develop some awareness of survivorship bias because they have often watched others fail, using approaches similar to their own. They know people who worked just as hard and were just as smart and did not make it, and this knowledge creates humility about their own success and caution about the advice they give. They know that what worked for them may not work for others, and that the sample of one that is their own experience is not sufficient to draw general conclusions. Topic: The role of geography. Where you live has a larger effect on your financial outcomes than most people realize, and this effect operates through multiple channels. Geographic areas differ in their job markets. Different places have different industries and different compensation levels and different growth trajectories. The same skills might earn twice as much in one city as another. Geographic areas differ in their costs of living, and the relationship between income and cost of living varies dramatically in some places. Modest incomes provide comfortable lives, and in others, high incomes barely cover basics. Geographic areas differ in their tax burdens. State and local taxes vary substantially, and these differences compound over time. Geographic areas differ in their networks and opportunities. Some places concentrate ambitious people and growing companies and available capital, while others do not. And being in the right place exposes you to opportunities that simply do not exist elsewhere. The wealthy tend to be deliberate about geography, treating location as a strategic choice rather than an accident of birth. They consider where they can maximize the gap between income and cost of living, where they have access to the opportunities and networks they need, and where the overall environment supports their goals. This might mean moving to a high-cost city when they are building career capital and access to opportunity matters most, and then moving to a lower-cost location once they have accumulated capital and no longer need to be in the center of their industry. The general principle is that geography is a variable you can control, and that treating it as fixed leaves a powerful lever unpulled. Topic: Industry selection. The industry you work in has an enormous effect on your earning potential that often dwarfs the effect of how hard you work within that industry. Different industries have different economics, different profit margins, different growth rates, different compensation structures, and these structural factors determine what is possible for individuals within them. A mediocre performer in a high-paying industry may earn more than an exceptional performer in a low-paying industry, simply because of where the money is. The same level of skill and effort produces vastly different outcomes, depending on which game you are playing. And yet people often choose industries based on passion or accident or whatever opportunity first presented itself, rather than on deliberate analysis of the economics. The wealthy tend to be more strategic about industry selection. They think about where value is being created and captured, where growth is happening, where the structural economics favor workers, rather than just owners where skills are scarce, and compensation reflects that scarcity. This does not mean you should only ever work in the highest paying industries passion and meaning matter, and some people thrive in fields that happen to pay less, but it does mean you should make that choice consciously, understanding the trade-offs, rather than drifting into an industry without considering its economics. Many people discover years into their career that they are working extremely hard in an industry where hard work cannot produce the outcomes they want. And the sooner you understand the economics of your industry, the sooner you can decide whether those economics work for you or whether you might be happier applying your talents somewhere else. Topic: the ownership principle. There is a principle that separates those who build substantial wealth from those who merely earn good livings, and that principle is ownership. The wealthy tend to own things that generate returns, assets that produce value whether they are personally working or not. They own businesses or pieces of businesses. They own real estate. They own intellectual property. They own investments. Workers, on the other hand, trade time for money. They are compensated for their labor, but they do not accumulate ownership of the value their labor creates when they stop working. The income stops. The transition from worker to owner is one of the most important transitions in building wealth. It means shifting from being an input in someone else's value creation to having a stake in value creation itself. This can happen in many ways: starting a business and owning equity in it, negotiating for equity compensation as an employee, investing in businesses, through the stock market, buying real estate that generates rental income, creating intellectual property that continues to earn after the initial work is done. The specific form matters less than the principle, which is that ownership creates wealth in a way that labor alone cannot. Because ownership compounds, labor does not. The wealthy often describe a shift in their thinking from how can I earn more to how can I own more, from how can I work harder to how can I build or acquire things that work for me. This shift changes what opportunities look attractive, what risks seem worth taking, and how time and energy are allocated. It is a fundamental reorientation from selling hours to accumulating assets. Chat's topic: equity. Thinking. Closely related to ownership is a concept that might be called equity thinking, which is the habit of evaluating opportunities in terms of the equity or ownership stake they provide, rather than just the immediate compensation. This way of thinking is common among the wealthy and rare, among those who struggle financially. The job that pays slightly less, but includes meaningful stock options, might be worth far more than the job that pays more in salary. If the stock appreciates, the consulting arrangement that includes a small equity stake in the client's business might be worth far more than the straight fee. If the business succeeds, the business partnership where you own a piece of the upside might be worth far more than the employment, where you are simply paid a wage equity. Thinking requires a certain tolerance for uncertainty, because equity is not guaranteed. It might be worth a lot, or it might be worth nothing. And many people prefer the certainty of a fixed payment to the potential of ownership. This preference for certainty is understandable, but it has a cost because the expected value of equity often exceeds the expected value of fixed payments, which is why employers offer it. They are paying with something that might be valuable, hoping to retain the option value themselves. The wealthy often describe equity thinking as second nature. They automatically evaluate any opportunity in terms of the ownership it might provide. They negotiate for equity when possible. They structure deals to include upside participation. They think of their career as a portfolio of equity positions, some of which will pay off spectacularly, and some of which will be worthless, rather than as a series of jobs that provide fixed salaries. Topic: Cash flow obsession. Among the concepts that the wealthy focus on more than others, cash flow stands out as particularly important. Cash flow is the movement of money into and out of your life, the difference between what comes in and what goes out in any given period. And while this seems like a simple concept, it is often neglected in favor of less useful metrics, like total income or asset values. The person focused on income might celebrate a raise without noticing that their expenses have risen to match, leaving cash flow unchanged. The person focused on asset values might feel wealthy because their home value increased without noticing that the increase is illiquid and does not help with actual bills. Cash flow is what pays for your life. Cash flow is what you can save and invest. Cash flow is what determines whether you are moving forward or backward financially, and the wealthy tend to monitor it obsessively, knowing exactly what is coming in and what is going out, and whether the gap between them is growing or shrinking. This focus on cash flow changes decision-making because it forces attention to the actual movement of money, rather than to theoretical values or occasional events. The business owner thinks about recurring revenue, not just big deals. The real estate investor thinks about monthly rental income, not just property appreciation. The employee thinks about the ongoing surplus after expenses, not just the annual salary number. Cash flow is unglamorous and incremental, but it is the actual mechanism through which wealth accumulates or erodes, and the wealthy keep their eyes on it constantly. Topic: The balance sheet. Life. There is a tool from business accounting that applies with surprising power to personal finance, and that tool is the balance sheet, which shows what you own and what you owe at a single moment in time, your assets on one side and your liabilities on the other, with the difference being your net worth. Most people never create a personal balance sheet. They have a vague sense of what they own and owe, but they have never actually listed everything and calculated the totals. The wealthy tend to know their balance sheet precisely. They can tell you their net worth and what it consists of and how it has changed over time, because they track it regularly, often monthly or quarterly. Creating a balance sheet does several things. It gives you an accurate picture of where you stand, rather than the fuzzy impressions most people operate with it. Forces you to account for debts that might otherwise be out of sight and out of mind. It creates a baseline against which you can measure progress, and it reveals the composition of your wealth. Whether you are too concentrated in one asset or too exposed to one type of risk. Once you have a balance sheet, you can manage it strategically. You can set goals for net worth growth. You can work on shifting the composition toward assets you want to hold. You can see the effect of decisions on your overall position rather than just on immediate cash flow. The discipline of maintaining a personal balance sheet transforms money from something that happens to you into something you actively manage. It is one of those simple tools that the wealthy use routinely, and that most people never think to adopt. Topic: Wealth metrics that matter. There is a tendency to focus on the wrong metrics when tracking financial progress, and this focus on the wrong numbers leads to the wrong behaviors and ultimately to worse outcomes. The most common mistake is focusing on income as the primary measure of financial success. But income is an input, not an output, and a high income that flows immediately out the door contributes nothing to wealth. What matters more is net worth, the total of what you own minus what you owe. And even more specifically, what matters is the growth rate of your net worth over time, because that growth rate tells you whether you are actually moving forward or just running in place. But even net worth has limitations as a metric, because it does not distinguish between liquid and illiquid assets. The person whose net worth is entirely in home equity has a very different financial situation than the person whose net worth is in diversified investments. Even if the number is the same, the home equity is trapped. It cannot pay bills or fund opportunities without selling the home or taking debt against it, while the investment portfolio can be accessed and deployed. The wealthy tend to track multiple metrics simultaneously: net worth, certainly, but also liquid net worth and passive income, and savings rate and cash flow. Each metric tells a different part of the story, and together they provide a comprehensive picture of financial health. Passive income deserves particular attention because it represents the progress toward financial independence, specifically how much income your assets generate without your labor. And the ratio of passive income to expenses tells you how close you are to the point where work becomes optional. When passive income exceeds expenses, you have achieved a form of freedom that most people never reach. And tracking this ratio provides motivation and guidance for the decisions that move you toward that threshold. The person who only tracks income misses all of this nuance. They might celebrate raises that do not actually improve their position, and they might not notice that their wealth is growing because their lifestyle has not changed. Topic: the 4% rule and its limits. There is a guideline that has become central to retirement planning called the 4% rule, which emerged from research examining historical market returns and attempting to answer a practical question: if you have a portfolio of investments, how much can you withdraw each year without running out of money? The research suggested that if you withdraw 4% of your portfolio in the first year of retirement, and then adjust that amount for inflation each subsequent year, your portfolio has historically survived for at least 30 years. In most market conditions, this guideline has been enormously influential because it provides a concrete number that people can plan around. If you need $40,000 per year in retirement, you need a portfolio of $1 million because 4% of $1 million is $40,000. If you need $80,000, you need $2 million, and so on. The rule creates a clear target to aim for. But the 4% rule has significant limitations that are not always acknowledged. It was derived from historical U.S. market returns, which may not predict future returns, especially in an era of lower interest rates than historical averages. It assumes a 30-year retirement, which may be too short. If you retire early or live longer than expected, it assumes you will spend the same inflation-adjusted amount each year, regardless of market conditions, which is not how most people actually behave. It does not account for taxes or healthcare costs, or the many other complications of real retirement. The wealthy tend to use the 4% rule as a rough guideline, rather than as a precise prescription. They often plan more conservatively, assuming 3% or even 2.5% withdrawal rates. To provide more cushion, they maintain flexibility to reduce spending in down markets. Rather than mechanically withdrawing, regardless of conditions, they plan for longer time horizons than 30 years, recognizing that early retirement or long life could extend the period their money must last. And they recognize that the rule provides a starting point for planning, not an answer to all the questions that retirement finance involves. Topic: sequence of returns. Risk. There is a risk in retirement planning that is not intuitive and that catches many people off guard, and it is called sequence of returns risk, which refers to the fact that the order in which investment returns occur matters enormously when you are withdrawing from a portfolio, not just the average return over time. Imagine two retirees who both experience average returns of 7% over 20 years, but one experiences poor returns in the early years and strong returns later, while the other experiences strong returns early and poor returns later. Their average return is identical, but their outcomes may be dramatically different because the person who experienced poor returns early was withdrawing from a shrinking portfolio, selling assets at low prices to fund their expenses. And once those assets were sold, they were not available to benefit from the later recovery, while the person who experienced strong returns early built a larger base that could better withstand the later poor returns. This sequence risk is highest in the years immediately before and after retirement, which is why financial planners often recommend becoming more conservative as retirement approaches. Not because average returns matter less, but because sequence risk creates a vulnerability that conservative allocation can mitigate. The wealthy tend to be acutely aware of sequence risk, and they plan around it. They might maintain a cash buffer of several years of expenses, so that they never have to sell investments during a downturn. They might use a bucket strategy with different time horizons, or they might maintain income sources in early retirement that reduce the need to withdraw from investments during the vulnerable early years. Understanding sequence risk changes how you think about the transition into retirement. It is not just about accumulating enough assets, but about protecting those assets during the critical period when poor returns could permanently impair your financial security. Our topic: The bucket strategy. One approach to managing retirement income that the wealthy often employ is called the bucket strategy, which involves mentally and sometimes physically dividing your assets into separate buckets based on when you will need the money. The first bucket holds cash and very conservative investments, enough to cover expenses for the next 1 to 3 years. This bucket provides security and stability. You know exactly where the next few years of expenses will come from, regardless of what markets do. The second bucket holds moderately conservative investments intended to replenish the first bucket over a medium time horizon of perhaps 3 to 10 years. This bucket provides growth while limiting volatility. The third bucket holds growth-oriented investments intended for the long term. Beyond 10 years, this bucket can afford to be aggressive because you will not need this money for many years, and it has time to recover from any downturns. The psychological benefit of the bucket strategy is that it separates the money you need soon from the money you need later, which makes it easier to tolerate volatility in the long-term bucket. When the stock market drops, you do not need to panic, because you know your near-term expenses are covered by the conservative bucket. The practical benefit is that it creates a systematic approach to managing withdrawals, drawing from the first bucket and periodically rebalancing from the other buckets to refill it. The wealthy often describe the bucket strategy as providing peace of mind because it transforms an abstract portfolio into concrete pools of money with specific purposes and time horizons. It answers the question that retirees most want answered: where will next month's expenses come from? And the answer is right here in this bucket, set aside for exactly this purpose. Topic: longevity. Risk. There is a risk that has become more significant as life expectancy has increased, and it is the risk of outliving your money, which actuaries call longevity risk. A century ago, this risk barely existed because most people did not live long past their working years. But today it is common to spend 20 or 30 years in retirement, and some people spend 40 years or more. And every additional year requires resources if you plan for a 30-year retirement and live for 40 years. Where do the last 10 years of expenses come from? The challenge is that you do not know in advance how long you will live, and planning for the longest possible lifespan means maintaining resources you may never need, while planning for an average lifespan means risking destitution if you exceed it. The wealthy tend to take longevity risks seriously, and they address it through several strategies. They plan conservatively, assuming a longer lifespan than they might actually have. They maintain investments even late in life, because the money needs to continue growing to support an uncertain time horizon. They consider annuities or other products that provide guaranteed lifetime income, transferring longevity risk to an insurance company that can pool it across many individuals. And they maintain flexibility to reduce expenses if their assets are depleted faster than expected. There is also a psychological dimension to longevity risk, which is that the fear of running out of money can prevent retirees from enjoying the money they have, leading to unnecessary deprivation late in life, followed by unspent assets left to heirs who would have preferred to see their parents enjoy themselves. The balance between spending enough to live well and saving enough to ensure security is one of the most difficult calibrations in retirement, and there is no perfect answer. Only thoughtful management of an inherently uncertain situation. Topic: the two types of risk. When people talk about financial risk, they often conflate two very different things that should be considered separately. The first type of risk is volatility, which is the fluctuation of values over time. The stock market goes up and down your portfolio. Value changes from month to month, and this movement can feel uncomfortable, especially when it is downward. The second type of risk is permanent loss, which is when money is actually gone and will not come back. The company you invested in goes bankrupt, and your investment is worthless. The money you lent is not repaid. The asset you bought declines and never recovers. These two types of risk are related, but they are not the same. Volatility is often temporary and recovers over time, while permanent loss is by definition not recoverable. The mistake many people make is treating volatility as if it were permanent loss, selling investments during downturns because the fluctuation feels unbearable, and thereby converting temporary volatility into permanent loss. The wealthy tend to distinguish clearly between these two types of risk. They accept volatility as the price of returns, understanding that the ups and downs are normal and that staying invested through the downs is essential to capturing the long-term gains. But they are very careful about permanent loss risk, avoiding investments where the entire principal could be wiped out, diversifying so that no single failure is catastrophic, and maintaining the ability to hold through downturns so they never have to sell at the bottom. This distinction changes how you evaluate investments. An investment that is volatile but unlikely to go to zero is very different from an investment that is stable but carries meaningful risk of total loss, and the appropriate response to each is different. Topic: Volatility versus permanent loss. Expanding on the distinction between volatility and permanent loss reveals important implications for how the wealthy think about their portfolios. Volatility is the normal breathing of markets. Prices move based on news and sentiment and trading flows, and countless other factors, and these movements often have little to do with the underlying value of the assets involved. A stock might drop 10% because of general market panic, even though nothing about the company has changed, and it might recover that 10% in the following weeks as panic subsides. Permanent loss occurs when something fundamental has changed. The company has failed or committed fraud or been displaced by competition. The asset has been destroyed or rendered worthless. The loan will not be repaid because the borrower has defaulted in these cases. Waiting for recovery is futile because there is nothing to recover. The money is simply gone. The wealthy protect against permanent loss through diversification, not putting too much in any single investment, so that any individual failure is survivable, through due diligence, researching investments thoroughly before committing capital, through quality focus, preferring investments with margin of safety over speculative bets, and through position sizing, limiting exposure to higher risk investments to amounts they can afford to lose entirely on the volatility side. The wealthy protect themselves differently. They maintain liquidity so they never have to sell. During downturns, they take a long time horizon so that short-term fluctuations become irrelevant. They limit how often they check their portfolios so that volatility does not trigger emotional reactions, and they reframe volatility as opportunity. Recognizing that downturns allow them to buy assets at lower prices. The investor who confuses volatility with permanent loss sells at bottoms, panics at downturns, and locks in losses that would have recovered. The investor who distinguishes them clearly can remain calm through volatility while being appropriately vigilant about genuine threats to principal. Topic: The insurance question. Insurance is a financial tool that many people misunderstand, using it either too much or too little. The fundamental principle of insurance is that you pay a small certain cost, the premium, to avoid a large uncertain cost. The potential loss, and this exchange makes sense when the potential loss would be catastrophic, when it would fundamentally change your life in ways you could not recover from. You should insure against losing your home to fire, because you probably could not easily replace it. You should insure against major medical expenses, because they could bankrupt you. You should insure against liability from accidents, because the damages could exceed everything you own, but you should probably not insure against minor losses, because the premiums over time will exceed the losses you would have experienced, and you are paying for the insurance company's overhead and profit. On top of that, the wealthy tend to follow a principle called self-insure. When you can insure when you must, they maintain large deductibles on policies, because they can absorb the small losses themselves, and the premiums for low-deductible policies exceed the expected value of the claims. They skip extended warranties and product insurance because the items covered are replaceable without financial hardship, but they maintain robust coverage for catastrophic risks, often with higher limits than standard policies provide, because they have more to protect the decision framework. For insurance is straightforward. What is the worst that could happen if this risk materializes? If the answer is financial ruin, then insure generously. If the answer is inconvenience but not catastrophe, then consider self-insuring. And if the answer is minor annoyance, then definitely self-insure. The goal is not to avoid all losses, but to avoid the losses that would fundamentally derail your financial life while not wasting money on protection against losses you could easily absorb. Topic: Umbrella policies. Among the types of insurance the wealthy almost universally carry is something called an umbrella policy, which provides liability coverage beyond what standard home and auto policies offer. The standard policy might cover up to $300,000 or $500,000 in liability, but lawsuits can easily exceed these amounts, especially if you have significant assets that a plaintiff might target. An umbrella policy extends this coverage typically to $1 million, $5 million, or even higher, providing protection against catastrophic liability claims that could otherwise wipe out accumulated wealth. The cost of umbrella policies is remarkably low, often just a few $100s per year for $1 million of coverage. Because the claims are relatively rare, the policy only kicks in after underlying coverage is exhausted, but the peace of mind is substantial. You are protected against the unlikely but devastating scenario where an accident you cause results in damages that exceed your primary coverage. The wealthy tend to carry umbrella coverage that approximates their net worth, or at least provides substantial protection against claims, because they recognize that visible wealth makes them targets for lawsuits, and that the cost of protection is trivial compared to the cost of exposure. This is one of those financial tools that most people do not know exists because insurance agents do not always mention it, and because people do not know to ask, but it is standard practice among those who have significant assets to protect. Topic: Estate planning. Basics. There comes a point in wealth accumulation where you must think about what happens to your assets when you are gone, and this thinking falls under the category of estate planning, which encompasses all the legal and financial arrangements that determine how your wealth transfers at death. Without estate planning, the state decides what happens to your assets, according to default rules that may not reflect your wishes. Your assets may go through probate, a public court process that is slow and expensive, and exposes your finances to anyone who cares to look, and your heirs may pay more in taxes than necessary because you did not take advantage of available strategies. The basic tools of estate planning are wills, which specify your wishes and name an executor to carry them out. Trusts, which hold assets outside of probate and can provide ongoing management and protection powers of attorney, which authorize someone to act on your behalf. If you become incapacitated, beneficiary designations on accounts like retirement funds and insurance policies, which pass directly to named beneficiaries outside of the will, and healthcare directives, which specify your wishes for medical treatment if you cannot communicate them yourself. The wealthy tend to have comprehensive estate plans created with attorneys who specialize in this area. Because the stakes are high and the details matter, they review and update these plans regularly as circumstances change, and they communicate their wishes to family members to avoid confusion and conflict after death. Estate planning is uncomfortable because it requires contemplating mortality, but the discomfort of planning is far less than the discomfort your heirs will experience if you fail to plan and leave them with a mess to sort out during an already difficult time. Topic: The trust advantage. Trusts are legal structures that hold assets for the benefit of designated beneficiaries, and they provide advantages that make them central to wealth preservation strategies. A trust separates legal ownership from beneficial ownership. The trustee legally controls the assets, but the beneficiaries receive the benefits, and this separation enables many useful arrangements, assets in a properly structured trust. Avoid probate passing directly to beneficiaries without court involvement, which saves time and money and maintains privacy. Since probate records or public trusts can provide ongoing management for beneficiaries who are not ready to manage assets themselves. Whether due to age or disability or simply inexperience, a trust can specify that a child receives income from assets, but does not control the principal until reaching a certain age, or meeting certain conditions. Trusts can provide asset protection depending on the type and jurisdiction, keeping assets safe from creditors or lawsuits or divorcing spouses. And trusts can provide tax advantages through strategies that reduce estate taxes or generation skipping taxes or income taxes. The wealthy use trusts extensively often creating multiple trusts for different purposes. Irrevocable living trust for probate avoidance, and irrevocable life insurance trust to keep insurance proceeds out of the taxable estate. Charitable trust to provide tax benefits while supporting causes they care about, special needs. Trust to provide for disabled family members without disqualifying them from government benefits. The specifics require professional guidance because trust law is complex and varies by jurisdiction. But the underlying principle is simple. Trusts provide control and protection, and tax efficiency that outright ownership does not. Topic: Giving while living. There is a pattern among the wealthy that has gained prominence in recent years, and it is the practice of giving while living rather than leaving all assets to be distributed at death. The traditional model was to accumulate throughout life and let heirs sort everything out after. But this model has drawbacks. You never get to see the impact of your generosity. You never get to guide recipients in how to use what you give. And the amounts involved are often larger than would have been optimal if distributed gradually over time. Giving while living addresses these issues by distributing wealth during the giver's lifetime, while they can still observe and participate. This might mean helping children buy homes or start businesses or pay for education, while the giver is alive to see the benefit it might mean. Donating to charitable causes and being involved in how the donations are used, it might mean gradually transferring ownership of a family business, rather than dumping it all at once upon death. There are also tax advantages to giving while living. Annual gift exclusions allow substantial transfers without gift tax and assets given away. Stop appreciating in the giver's estate, which can reduce eventual estate taxes. The wealthy often describe giving while living as more satisfying than the traditional model, because they experience the joy of generosity, rather than just knowing abstractly that their assets will eventually go somewhere. The key is balance, maintaining enough for your own security, while being willing to part with assets that exceed what you need, and timing gifts so that recipients are ready to receive them responsibly. Topic: Charitable vehicles. When the wealthy want to support charitable causes, they often do so through specialized vehicles that provide tax advantages and ongoing involvement. Rather than through simple donations, the most common is the donor-advised fund, which allows you to make an irrevocable contribution, get an immediate tax deduction, and then recommend grants to charities over time from the fund. This separates the tax benefit from the charitable distribution. You might contribute appreciated stock during a high-income year, get the deduction when you need it, and then distribute to charities gradually. Over subsequent years, charitable remainder trusts are another vehicle. You contribute assets to the trust, receive an income stream for life, and the remainder goes to charity at death, providing a current tax deduction and ongoing income. Private foundations provide the most control, allowing you to create a permanent institution with your name that pursues charitable purposes according to your direction. But they require substantial assets to be worthwhile and involve significant administrative burden. The wealthy often use combinations of these vehicles, matching the structure to their goals and circumstances. The underlying principle is that thoughtful, charitable giving can accomplish multiple objectives at once, supporting causes you care about, reducing taxes, and providing income, or involving family members in philanthropy. The person who simply writes checks to charity is missing opportunities to amplify their impact and accomplish their goals more efficiently. This does not mean charitable giving should be primarily about tax benefits. The motivation should be genuine desire to contribute. But given that you have that desire, structuring your giving wisely allows you to give more and give more effectively. Topic: The purpose of wealth. At some point in the accumulation of wealth, a question arises that money itself cannot answer, and that question is, what is this all for? What is the purpose of accumulating resources beyond immediate needs? The person who never asks this question risks becoming trapped in accumulation for its own sake, adding to the pile compulsively without any sense of what the pile is meant to accomplish. And this is a kind of poverty, a poverty of purpose, even amid abundance of resources. The wealthy who seem most content have usually answered this question for themselves, and their answers vary widely. Some see wealth as security, a buffer against uncertainty, and a source of peace of mind. Some see it as freedom, the ability to control their own time and pursue what interests them. Some see it as power, the capacity to influence events and shape outcomes. Some see it as legacy, something to pass to future generations or to causes that will outlive them. Some see it as scorecard, a measure of success in the game. They have chosen to play. There is no single right answer, but having an answer matters because without purpose, accumulation becomes hollow, and the behaviors required to build wealth, such as deferred gratification and disciplined saving, lose their meaning when there is no vision of what the discipline is serving. The wealthy often describe moments when they stepped back and asked themselves these questions, and the answers they arrived at often changed how they pursued and used wealth. The person who realizes that security is their primary purpose stops accumulating once security is achieved. The person who realizes that freedom is their purpose arranges their wealth to maximize freedom rather than maximum return. The purpose shapes everything. Topic: Enough. The hidden number. There is a number that most people have never calculated, but that might be the most important financial number they could know, and that number is enough. The amount of wealth at which additional accumulation adds nothing meaningful to your life. The concept of enough is counterintuitive in a culture that celebrates more, but it is essential to financial well-being because, without a sense of enough, you are condemned to perpetual striving. Regardless of what you have achieved, you reach one goal and immediately set a higher goal. You accumulate 1 million and immediately fixate on 2 million. There is no rest, no arrival, no ability to enjoy what you have created because you are always focused on what you have not yet created. The wealthy who have thought about enough have usually arrived at a number or at least a range that represents genuine sufficiency for them. This number accounts for their actual needs and wants, not hypothetical desires or status competition. It includes buffer for security and provisions for heirs and capacity for generosity, but it does not include unlimited accumulation for its own sake. Knowing your enough number changes everything because it provides a destination rather than an endless treadmill. You can push hard to reach enough and then ease off. Once you arrive, you can take risks early when you are far from enough and become conservative as you approach it. You can recognize when you have won the game and stop playing or continue playing for enjoyment rather than for desperation. Calculating enough requires honest self-examination. What do you actually need? What do you actually want? And what are you pursuing only because it is what people pursue? The answers might surprise you, and they might reveal that enough is closer than you thought. Topic: Money and happiness. Research. The relationship between money and happiness has been extensively studied, and the findings are more nuanced than either money buys happiness or money cannot buy happiness. The research consistently shows that money matters a great deal for happiness up to a point. Lack of money causes genuine suffering. Financial stress is corrosive to well-being, and having enough to meet basic needs and achieve basic security substantially improves life satisfaction. But above that threshold, the relationship weakens. Additional money produces diminishing returns, and eventually very little additional happiness at all. The exact threshold varies by study and by location, but it is lower than most people assume, somewhere in the range of comfortable middle class, rather than wealthy. And this has important implications for how to pursue happiness through money. The early dollars matter most, so reaching basic security should be the priority. The later dollars matter less so, sacrificing happiness today for additional wealth. Tomorrow may be a poor trade, and the things that actually predict happiness, once basic needs are met, are mostly not purchasable: relationships and meaning and engagement and health and contribution. These require time and attention and presence more than they require money. The wealthy who report high life satisfaction tend to have figured this out. They use their money to buy time and to invest in relationships and to pursue meaningful work. They do not assume that more money will automatically produce more happiness, and they do not sacrifice the things that actually matter for the things that only seem to matter. The research suggests they are right. Topic: The Peak and Plateau. related to the question of enough is an observation about how satisfaction with wealth actually changes. As wealth increases for most people, there is a peak somewhere above basic security but below extreme wealth, where the subjective experience of having money is most positive at this peak. You have enough to feel secure enough to have choices, enough to be comfortable, but you have not yet experienced the complications that very high wealth brings. The isolation, the suspicion of others' motives, the loss of normal life experiences, the burden of managing complexity, the anxiety about maintaining and protecting what you have accumulated beyond this peak. The returns diminish, and sometimes the curve actually reverses, with additional wealth producing additional complications that subtract from well-being. The wealthy who are most candid often describe this pattern. They remember the period when their wealth was growing, but not yet extreme, as happier than their current situation, when wealth brings expectations and obligations and loss of anonymity. This does not mean you should avoid wealth or cap your accumulation artificially, but it does mean you should not expect the feeling to keep improving indefinitely. The assumption that twice as much wealth will feel twice as good is simply wrong, and building your life around that assumption will lead to disappointment. The practical implication is to optimize for the peak, rather than for the maximum, which often means reaching a comfortable level of wealth and then directing additional energy toward the non-financial sources of satisfaction that actually scale the relationships and experiences and contributions that continue to improve life well after wealth has plateaued. Topic: Experiences versus things. There is substantial research comparing the happiness derived from spending money on experiences versus spending money on physical possessions, and the research consistently favors experiences. For several interesting reasons, experiences become part of your identity in a way that possessions do not. When you think about who you are, you think about what you have done and seen and learned, not about what you own. Experiences connect you with other people, either directly through shared experiences or indirectly through stories you tell, while possessions often isolate you into individual consumption. Experiences are unique and cannot be directly compared, while possessions invite unfavorable comparison. There is always a better car or a nicer house, but your trip was your trip. Experiences improve in memory through rosy retrospection. We forget the inconveniences and remember the highlights, while possessions often disappoint as the novelty fades and flaws become apparent. The wealthy who report high life satisfaction tend to tilt their spending toward experiences rather than possessions they travel. They learn, they gather with friends and family. They try new things. They invest in memories rather than in objects. And when they do buy objects, they often buy objects that facilitate experiences, rather than objects for their own sake. This does not mean all possessions are worthless. Some objects genuinely improve daily life, and some become deeply meaningful over time. But the research suggests that when choosing between spending on experiences and spending on possessions, the experience is usually the better bet for happiness. Topic: The memory dividend. Closely related to the experience versus possession research is a concept that might be called the memory dividend, which is the ongoing happiness that experiences provide through memory long after the experience itself has ended. When you take a trip or share a special occasion or try something new, you receive happiness in 3 phases: anticipation before the event, enjoyment during the event, and memory after the event. The memory phase can last for decades, providing repeated returns every time you recall the experience or tell the story about it. This is in contrast to most possessions, which provide happiness primarily at the moment of acquisition and during initial use, but little ongoing dividend through memory. You probably do not fondly recall buying your washing machine or look at photos of your everyday purchases, but you likely do recall meaningful experiences and enjoy retelling them. The wealthy who understand the memory dividend are strategic about creating memorable experiences. They invest in experiences that will be recalled, frequently experiences with loved ones, experiences that are unique, experiences that mark important occasions. They document these experiences through photos and journals, knowing that the documentation will enable future retrieval of the memory and they share the stories, keeping the memories alive through retelling the memory. Dividend also suggests that some of the best investments are in experiences. For others, helping family and friends create memories provides happiness not just to them, but to you through shared memory and the satisfaction of having contributed to others' joy. Topic: buying time. If there is one thing that money can buy that reliably increases happiness, it is time, specifically freedom from tasks that drain you and freedom to spend your hours on things that matter to you. Hiring someone to clean your house or mow your lawn or handle administrative tasks costs money, but it returns hours that can be spent with family, or on health, or on meaningful work, or simply on rest. And this trade often improves happiness in ways that buying possessions does not. Research has found that people who spend money to buy time report greater life satisfaction than those who spend similar amounts on possessions, even when the purchases seem less exciting or prestigious. Buying time often requires overcoming psychological resistance. We feel guilty paying others to do things we could do ourselves. We worry about seeming lazy or extravagant. We undervalue our own time and over-focus on the explicit cost of outsourcing. The wealthy tend to have gotten over these resistances, and they buy time aggressively. They outsource tasks they do not enjoy. They hire help to handle things that distract from their priorities. They value their hours highly, and they spend money freely to protect those hours. This is not laziness. It is recognition that time is the ultimate limited resource, and that using money to reclaim time is often the best possible use of that money. The key is being intentional about what you do with the time you buy. If you outsource housework and then spend the freed hours watching television mindlessly, you have not gained much. But if you spend those hours with your children or on creative work or on rest that restores you, then the purchase was an excellent investment. Topic: the freedom point. There is a specific threshold in wealth accumulation that represents a qualitative shift, and that threshold is the freedom point, the amount of wealth at which work becomes optional because investment income or passive income covers your expenses. Below this point, you must work whether you want to or not, because your lifestyle depends on the income from your labor. Above this point, you can choose to work or not, based on what you want, rather than what you need. The freedom point varies enormously, depending on your lifestyle and location and expectations. Someone with modest needs in a low-cost area might reach freedom with $500,000, while someone with expensive tastes in a high-cost city might need many millions. But whatever the number, reaching it transforms your relationship with work and with money. You no longer take jobs because you need the money. You take them because you find them meaningful. You no longer tolerate toxic workplaces because you have no alternative. You have the ultimate alternative, which is walking away. You no longer feel trapped by obligations that do not serve you, because obligations become choices when you can afford the consequences of choosing differently. The wealthy who have passed the freedom point often describe a fundamental shift in how they experience life. The background anxiety about money disappears. The resentment of obligatory work evaporates. The sense of being controlled by circumstances gives way to a sense of being in control of your own path. Reaching the freedom point does not mean you stop working. Many people who reach it continue to work harder than ever, because they love what they do, but the work feels different when it is chosen rather than compelled. Topic: identity and money. The relationship between your identity and your money is deeper than most people realize. Your sense of who you are is often entangled with how much you have, what you do for money, and how you compare to others financially. This entanglement can be problematic if your identity is built on being wealthy. Then any threat to your wealth becomes a threat to your sense of self. If your identity is built on being a hard worker, then retiring becomes psychologically difficult. Even when it is financially optimal, if your identity is built on providing for others, then asking for help feels impossible even when help is needed. The wealthy who navigate these identity issues successfully tend to have built identities that are not entirely dependent on their financial status. They know who they are apart from their wealth, and they can separate their value as people from the numbers in their accounts. This does not happen automatically. It requires deliberate reflection on where identity comes from and which sources of identity are healthy and sustainable. The person whose identity rests on always having more may never be satisfied, regardless of how much they accumulate, because there is always someone with more. The person whose identity rests on contribution or connection or growth can remain grounded regardless of financial fluctuations. Understanding your own identity relationship with money helps you recognize when financial decisions are being driven by identity needs rather than by rational analysis, and it helps you build an identity that supports rather than undermines your financial well-being. Topic: Money stories. We tell. Everyone carries stories about money narratives that explain what money means and how it works and what is possible and what is not. These stories are often so deeply embedded that they feel like facts rather than stories, like descriptions of reality rather than interpretations of reality. But they are stories, and they can be examined and questioned and sometimes revised. One person might carry a story that money is hard to get, that wealth comes only through struggle and sacrifice, and that anyone who seems to have it easy must be cheating. Somehow, another person might carry a story that money flows easily when you provide value, that wealth is available to anyone who creates something worthwhile, and that abundance is natural rather than exceptional. These are different stories about the same reality, and they lead to very different behaviors and outcomes. The person who believes money is hard to get will approach opportunities with suspicion and hesitation, while the person who believes money flows easily will approach opportunities with openness and confidence. The wealthy often describe moments when they became aware of the stories they were carrying, and when they deliberately chose new stories that served them better. They recognized that the story they inherited from their family or absorbed from their culture was not the only possible story, and they gave themselves permission to write a different narrative. This is not about positive thinking or denying reality. It is about recognizing that interpretation shapes experience, and that choosing your interpretation is one of the few things fully within your control. Topic: Financial shame and secrecy. Money is one of the most shame-laden topics in modern life, and this shame creates secrecy that prevents people from getting the help they need and from learning from others' experiences. We feel shame about not having enough, and we feel shame about having more than others. We feel shame about debt and about mistakes and about not knowing things. We think we should know. This shame keeps us from talking honestly about money, from asking questions when we are confused, from seeking advice when we are struggling, and from sharing our experiences in ways that might help others. The wealthy are often no better at this than anyone else. They may feel guilty about their wealth, or anxious about others' judgment, or isolated by the secrecy that surrounds their financial situation. But those who break through the shame and learn to talk about money openly often describe it as liberating. They discover that most people struggle with similar issues, that making mistakes is universal, that not knowing everything is normal, and that sharing experiences creates connection rather than judgment. The practical benefit of reducing shame around money is that it enables learning and help seeking. The person who can ask questions without embarrassment learns faster than the person who pretends to know everything. The person who can discuss their situation honestly with a professional gets better advice than the person who hides relevant information. And the person who can talk about money with family and friends builds relationships that include this crucial dimension of life rather than excluding it. Topic: Talking about money. The taboo against talking about money is so strong in many cultures that people will discuss almost anything else before they discuss their financial situations. And this silence has costs that are rarely acknowledged. When you do not talk about money, you do not learn from others' experiences. You do not know what salaries are normal in your field, which weakens your negotiating position. You do not know what financial strategies are working for people in situations similar to yours. You do not know whether your struggles are common or unusual. You operate in isolation, making decisions without the benefit of others' wisdom. The wealthy often describe breaking this taboo as one of the most valuable things they did, finding communities where honest discussion of money was normal, and learning more from those conversations than from any book or course. they discovered that their assumptions were often wrong, that strategies they had never considered were available to them, and that the shame they felt about certain aspects of their finances was shared by many others who were also hiding it. This does not mean broadcasting your financial details to everyone or asking intrusive questions, but it does mean finding contexts where honest conversation is possible, whether with close friends or with professionals, or in communities organized around financial topics. The person who can talk openly about money has access to collective wisdom that the person who maintains the silence does not. And over time, this access translates into better decisions and better outcomes. The challenge is finding the right people to talk with and creating the trust that enables honest conversation, but the effort is worthwhile because the alternative is figuring everything out alone. Topic: the comparison trap. There is a trap that captures many people and prevents them from ever feeling satisfied with their financial situation. And that trap is comparison, the constant measuring of your own position against the positions of others. This trap is inescapable in one sense, because we are social creatures and we naturally situate ourselves relative to our reference groups. But it becomes destructive when the comparison prevents appreciation of what you have and drives endless striving for what others have. The problem with comparison is that you always compare yourself to people who have more, not to people who have less. And you compare your full situation to their visible situation, which is usually just the good parts. Someone always has a nicer house, a better car, a more impressive title, a larger portfolio. And if you measure your satisfaction by these comparisons, you will never be satisfied, because there is always someone ahead of you. The wealthy who report high satisfaction have often found ways to escape the comparison trap. They have stopped comparing, or they have chosen different reference groups, or they have shifted from comparing possessions to comparing things that matter more, like relationships and contributions and experiences. They recognize that comparison is a game with no winner, because the reference point keeps moving, and because you can never have more than everyone. The alternative to comparison is gratitude, focusing on what you have rather than what you lack, and appreciation, which means recognizing the value of your situation, independent of how it compares to anyone else's. This is not easy because comparison is automatic and deeply ingrained, but it is possible. And for those who manage it, the result is a kind of contentment that no amount of additional wealth can provide. Topic: gratitude and wealth perception. There is research showing that gratitude changes how you experience whatever level of wealth you have. The practice of deliberately noticing and appreciating what you have shifts attention away from what you lack. And this shift changes subjective experience, even when objective circumstances remain the same. Two people with identical financial situations can have completely different experiences. One feeling poor because they focus on what is missing, and one feeling abundant because they focus on what is present. And the difference is not in the money, but in where attention is directed. This has practical implications because it suggests that part of the solution to financial dissatisfaction is not more money, but different attention, that you can feel wealthier without actually becoming wealthier. By changing how you relate to what you have, the practice of gratitude can take many forms. A daily listing of things you are grateful for, a regular review of how far you have come, rather than how far you have to go. A deliberate focus on the basics, like health and relationships that are easy to take for granted. The wealthy who report high satisfaction almost always describe some form of gratitude practice, whether they call it that or not. They have cultivated the habit of appreciating their situation rather than always looking for what is next. And this habit allows them to enjoy their wealth in a way that those caught in the comparison trap never can. It is one of those paradoxes of human psychology that the feeling of wealth depends less on how much you have than on how you relate to what you have, and that changing the relationship is often easier than changing the amount. Parker's topic: simple systems. Win. There is a tendency when learning about personal finance to add complexity, to accumulate strategies and accounts and investments until the system becomes so complicated that it is impossible to maintain. And this complexity often does more harm than good, because the perfect system that you cannot follow is worse than the simple system that you can. The wealthy often describe a process of simplification over time as they gained experience. They eliminated the unnecessary. They consolidated accounts. They chose approaches that were robust and easy to maintain over approaches that were theoretically optimal but practically difficult. They recognized that in personal finance, as in many domains, simple systems win. They win because they actually get implemented while complex systems sit neglected. They win because they are easier to understand and communicate and adjust. They win because they reduce decision load and the errors that come from managing too many moving parts, and they win because they are resilient. When complex systems with many interdependencies are fragile, a simple system might be automatic savings, a diversified portfolio of index funds, periodic rebalancing a budget that tracks one or two key categories insurance against catastrophic risks, and nothing else. No elaborate spreadsheets, no constant optimization, no chasing of the latest strategy, just a few basic elements consistently maintained. This will not be the theoretical maximum you could achieve with more sophistication, but it will be far better than the theoretical maximum you never implement, and it will leave mental energy for the rest of your life rather than consuming all available attention on financial management. Topic: the one-page financial plan. Related to the idea of simple systems is a concept that some financial advisors promote called the one-page financial plan, which is exactly what it sounds like. Your entire financial strategy summarized on a single page. The discipline of condensing everything to one page forces clarity because you cannot fit complexity on one page. You must identify what actually matters and let go of the rest. A one-page plan might include your core goals expressed in a few sentences, your target savings rate, your asset allocation percentages, your insurance coverage, amounts, your estate, plan summary, and nothing more. Everything else is implementation detail. That does not need to be in the plan itself. The value of this exercise is not the document itself, but the thinking required to create it. When you try to fit everything on one page, you discover what is essential and what is noise. You recognize where you are overcomplicating and where you can simplify. And you end up with a document that you can actually refer to and follow, rather than a lengthy plan that sits in a drawer unread. The wealthy often describe their financial strategy in simple terms, not because they are unsophisticated, but because they have thought deeply enough to extract the essence. They can explain what they are doing and why in a few minutes without jargon or complexity, and this clarity serves them. Because a strategy you understand is a strategy you can follow, while a strategy that confuses you is a strategy you will eventually abandon. Hot topic: knowing what you own. There is a basic question that surprisingly many people cannot answer with confidence, and that question is, what do you own specifically? What assets do you have? What accounts hold them? What investments are in those accounts? What debts offset them? And how does it all add up? The inability to answer this question is common even among people with substantial assets, because accounts accumulate over time, with old retirement plans from previous jobs and investment accounts opened years ago, and property acquired at various points, and the whole picture becomes fragmented and confusing. The wealthy tend to know exactly what they own. They have consolidated where possible and organized what cannot be consolidated, and they review their complete picture regularly. This knowledge enables everything else because you cannot manage what you do not understand. You cannot optimize an allocation. You cannot see. You cannot identify risks you do not know you are taking. Knowing what you own requires periodic effort. Reviewing all accounts, updating net worth tracking, checking that beneficiary designations are current, ensuring that nothing has been forgotten. But this effort pays dividends because it transforms a vague sense of having stuff into a clear picture that can be managed and improved. The first step is simply listing everything, every account, every asset, every debt in one place and seeing the complete picture for perhaps the first time for many people. This exercise itself reveals surprises, forgotten accounts, outdated allocations, risks they did not realize they were taking, and the clarity enables better decisions going forward. Topic: the long game. Financial success requires playing a long game, thinking in terms of years and decades, rather than days and months. And this time horizon is fundamentally at odds with how human psychology naturally operates. We are wired to prioritize immediate rewards over distant ones, to respond to urgent signals, while ignoring slow trends, to discount the future heavily in favor of the present. And these tendencies served us well in ancestral environments, but they sabotage financial decisions in modern economies, where the best strategies require patience measured in decades. The long game means accepting that progress will be slow and often invisible, that the right decision today may not pay off for years, that compound growth takes time to become apparent, and that short-term fluctuations are noise to be ignored, rather than signals to be acted upon. Playing the long game requires controlling the parts of your psychology that want immediate results, that want to see progress, now that get bored with strategies that do not produce visible change. And this control is difficult because the short-term oriented impulses are strong and constant, while the long-term reasoning must be deliberately maintained. The wealthy often describe learning to play the long game as one of the most important shifts in their financial lives. They stopped chasing quick returns and started building slowly. They stopped reacting to every piece of news and started ignoring most of it. They stopped measuring progress by the month and started measuring by the decade. And the paradox is that this patient approach often produces faster results than the impatient approach, because the impatient approach generates costs through mistakes and trading and chasing, while the patient approach lets compound growth do its work uninterrupted. Topic: Patience as edge. In a world where everyone is looking for an edge, some advantage that produces better results, there is an edge that is available to anyone willing to claim it. And that edge is patience. Most people cannot be patient. They want results. Now they check their investments constantly. They react to every market movement. They change strategies when results do not appear immediately. They abandon approaches before those approaches have had time to work. And this impatience creates opportunity for those who can wait, because the patient investor buys what the impatient investor is panic selling. And the patient builder constructs what the impatient builder abandons. Halfway through, patience is an edge, because it is rare, and because it aligns with how wealth actually builds, which is slowly, and then suddenly, the first 90% of the compound growth curve looks like nothing is happening, and only those who wait through that period see the explosion at the end. The wealthy often describe patience as their primary advantage, not superior intelligence, or better information, or more resources, just the willingness to wait longer than others. This is encouraging because patience is not something you are born with or without. It is something you can cultivate through practice and through understanding why it matters. Once you truly understand how compound growth works, once you have internalized that, the gains come at the end. Patience becomes easier because you know what you are waiting for, and you know that waiting is not passive but is actually the most powerful thing you can do. Topic: The investor's worst enemy. There is an enemy that destroys more wealth than any market crash or economic recession, and that enemy is the investor themselves specifically. Their emotional reactions to market movements and financial news. The data on this is striking. The average investor significantly underperforms the average investment they hold, which seems impossible until you understand the mechanism. The investment performs according to its nature, rising and falling with markets, but the investor buys and sells at the wrong times, buying after rises when excitement is high and selling after falls when fear is overwhelming. And this pattern of buying high and selling low, driven by emotional reaction rather than rational analysis, destroys enormous amounts of wealth. The wealthy who have succeeded as investors have usually found ways to protect themselves from themselves. They automate investments so that emotions do not drive timing. They avoid checking portfolios frequently so that volatility does not trigger reactions. They create rules in advance for how they will respond to various scenarios so that they do not have to make decisions in the heat of the moment. They have learned that their own psychology is the primary risk, and they have built systems to manage that risk. This is humbling because it means acknowledging that you cannot trust yourself to make good decisions under emotional pressure, that your instincts will lead you astray, that you need external constraints to save you from your own reactions. But this humility is the foundation of investment success. The investor who believes they can time the market and manage their emotions perfectly is the investor who destroys their own wealth. The investor who acknowledges their limitations and builds around them is the investor who lets compound growth work. Topic: market timing. Futility. The idea of market timing is seductive by: before markets rise, sell before markets fall, and capture gains while avoiding losses. But the evidence overwhelmingly shows that market timing does not work for almost anyone. Almost ever, the future direction of markets is not predictable, with the reliability required to make timing profitable, and the costs of trying, including transaction costs, tax consequences, and missed gains when you are out of the market, typically exceed any gains from successful timing. Even professional investors with vast resources and sophisticated models rarely beat the market consistently through timing, and individual investors with less information and more emotional involvement do even worse. The math of market timing is unforgiving. You have to be right twice, once when you exit and once when you re-enter. And each decision is difficult because markets can move in either direction for extended periods. Being out of the market during just a few of the best days, which are unpredictable in advance, dramatically reduces long-term returns, and the best days often occur during volatile periods when fearful investors are likely to be on the sidelines. The wealthy who have built substantial portfolios through investing almost universally describe abandoning market timing as a crucial step in their development. They stopped trying to predict and started simply holding. They recognized that time in the market beats timing the market, and they accepted that they would experience the downs along with the ups. This acceptance is psychologically difficult, but it is also financially essential, because the alternative is a futile attempt at prediction that usually destroys more value than it creates. Topic: the cost of financial illiteracy. There is a price that people pay for not understanding money, and that price is substantial and lifelong. The financially illiterate pay more for credit, because they do not understand how interest compounds, and they accept terms that sophisticated borrowers would refuse. They save less for retirement, because they do not understand how critical early savings are, and they delay until it is too late. They pay more in taxes, because they do not understand the strategies available to reduce their burden. They make worse investment decisions, because they do not understand risk and return. And diversification, they fall for scams, because they cannot distinguish legitimate opportunities from fraudulent ones, and they accumulate less wealth over their lifetimes, because every financial decision is slightly worse than it would have been with better understanding. The aggregate cost of these mistakes is enormous, potentially hundreds of thousands of dollars over a lifetime, and yet financial literacy is not taught in most schools, and is often not taught at home, either leaving people to figure things out through expensive trial and error. The wealthy almost universally describe investing in financial education as one of the highest return investments they ever made. Not formal education necessarily, but self-education through books and courses and conversations and experience. Each hour spent learning about money paid returns for decades, because it improved every subsequent financial decision. The good news is that financial literacy is achievable. It does not require advanced mathematics or special aptitude, just willingness to learn, and the knowledge compounds like money itself. Each concept you understand makes the next concept easier to grasp. Topic: the information diet. In the modern world, there is an overwhelming flood of financial information news about markets, opinions about the economy, predictions about the future, advice about what to do. And most of this information is not just useless, but actually harmful, because it triggers emotional reactions that lead to poor decisions. The financially sophisticated have learned to go on an information diet, deliberately limiting their exposure to financial news and opinion, because they recognize that more information does not lead to better outcomes and often leads to worse ones. The daily fluctuations of markets are noise, not signal, and tracking them closely creates anxiety and temptation to act when the right action is almost always to do nothing. The predictions of experts are no more reliable than chance, and treating them as meaningful leads to constant strategy changes that generate costs without benefits. The breathless coverage of economic events creates a sense that something must be done, when in fact nothing must be done. The wealthy often describe radically reducing their financial news consumption as freeing. They stopped watching financial television, stopped reading daily market reports, stopped tracking their portfolios obsessively, and discovered that their results improved because they stopped making the mistakes that the information was triggering. This does not mean ignoring finances entirely. It means distinguishing between information that actually informs decisions and information that just creates noise and being ruthless about filtering out the latter. The question to ask of any financial information is, does this actually change what I should do? And if the answer is no, then the information is just entertainment at best and a source of costly mistakes at worst. Topic: Professional advice. Value. There is a question that people at various stages of wealth accumulation ask, which is whether professional financial advice is worth the cost. And the answer is complicated, because it depends on what kind of advice, from what kind of professional, and what your alternative is. The value of professional advice lies not primarily in superior investment selection, because most professionals do not beat the market consistently, but in other areas, behavioral coaching that helps you avoid costly emotional mistakes, comprehensive planning that considers taxes and estate and insurance and other factors you might neglect on your own time savings, that free you to focus on earning and living, rather than on managing money accountability that keeps you following your plan, when you might otherwise stray in expertise in complex situations that exceed your own knowledge. The cost of professional advice varies enormously from the high fees of traditional advisors who charge 1% or more of assets annually, to the lower costs of fee-only planners who charge flat rates for specific services. The key is matching the cost to the value you actually receive, and being clear about what value you are seeking. A simple situation may not need expensive ongoing advice, while a complex situation with significant assets may justify substantial professional fees. The wealthy tend to use professionals strategically engaging them for specific needs, where expertise adds value, while handling simpler matters themselves. They view professional advice as a tool to be used when appropriate, rather than either as an unnecessary expense to be avoided entirely, or as a service to be paid for, regardless of whether value is being received. Topic: Financial. Independence paths. There are multiple paths to financial independence, and understanding that you have options allows you to choose the path that fits your circumstances and values, rather than assuming there is only one way. The most common path is gradual accumulation through decades of saving and investing, working a traditional career and reaching independence in middle age or later. But this is not the only possibility. Another path involves dramatically reducing expenses, so that a smaller amount of savings is sufficient to cover needs and independence arrives sooner. This is sometimes called the lean financial independence approach, and it trades higher consumption for earlier freedom. Another path involves building businesses or creating assets that generate income, independent of your labor, reaching independence not through accumulation of investment assets, but through creation of income-producing systems. Another path involves geographic arbitrage, earning in a high-income location and then relocating to a lower-cost location where the savings go further. Each path has trade-offs. The gradual accumulation path is reliable but slow. The lean path arrives faster but requires sustained frugality. The business path can be faster still but carries more risk. The geographic path can accelerate timeline but requires willingness to relocate. The wealthy who have achieved independence have often combined elements of multiple paths, increasing income while reducing expenses, while building systems, while thinking strategically about location, and they have usually customized their approach to fit their specific situation, rather than following a template. Blindly understanding that multiple paths exist expands your sense of what is possible and helps you design an approach that works for you. Topic: The Frugality Spectrum. There is a spectrum of approaches to spending and saving that ranges from extreme frugality at one end to extreme consumption at the other, and most people have never consciously chosen where on this spectrum they want to be. They simply default to whatever feels normal, which is usually determined by their reference group and by marketing messages, rather than by deliberate reflection on their own values. Extreme frugality involves minimizing all expenses, living on a fraction of income, and reaching financial independence very quickly, but at the cost of forgoing many pleasures and conveniences along the way. Extreme consumption involves spending everything or more than everything, enjoying maximum material comfort now, but at the cost of never building wealth and never achieving independence. Most people fall somewhere in between, but the exact point matters enormously for outcomes. The person who saves 10% lives, one life. The person who saves 50% lives, a very different life. And neither is objectively correct. They simply reflect different trade-offs between present enjoyment and future freedom. The wealthy have usually thought deliberately about where they want to be on this spectrum. They have examined their actual preferences, rather than assumed preferences, and chosen a point that reflects what they genuinely value, rather than what they think they should value, or what others around them have chosen. Some have chosen aggressive frugality, because they value independence more than consumption. Others have chosen more moderate approaches because they value present experience highly. The key is conscious choice, rather than unconscious drift, because the default setting is typically high consumption driven by marketing and social pressure, and this default rarely reflects what people actually want when they stop to think about it. Topic: Minimalism and money. There is a connection between minimalism, the practice of intentionally living with fewer possessions, and financial health that goes beyond the obvious savings from buying less stuff. Minimalism changes your relationship with consumption itself by breaking the automatic assumption that more is better, and that acquiring things is the path to satisfaction. When you practice minimalism, you become more aware of what you actually need and use, as opposed to what you acquire out of habit or impulse. You discover that most purchases do not actually improve your life, and that the stuff you accumulate often becomes a burden. Requiring storage and maintenance and mental energy to manage, this awareness persists. Even if you do not become an extreme minimalist, it shifts the default from acquisition to restraint. And this shift has financial consequences, because consumption that would have happened automatically now gets questioned. The wealthy often describe some form of minimalist thinking. Even if they do not use that word, they are intentional about what they acquire, and they regularly eliminate what no longer serves them. They have broken free from the cultural assumption that success means accumulating more and more possessions. And they have discovered that freedom often feels like having less, rather than having more. This is not about deprivation. It is about the recognition that possessions have costs beyond their purchase price, and that a life cluttered with stuff you do not actually use is not a wealthy life, but an encumbered one. Topic: Values-based spending. There is an approach to spending that transcends both frugality and consumption, and it is called values-based spending, which means aligning your spending with what you actually value, rather than with what you think you should value or what others value. The idea is simple, but the execution is difficult because it requires genuine self-knowledge. Most people have not examined what they truly value. They have absorbed values from family and culture and advertising without questioning whether those values are actually theirs. And so their spending reflects a jumble of influences rather than coherent priorities. Values-based spending starts with identifying what actually matters to you. Not what should matter, but what genuinely brings you satisfaction and meaning. Once you have identified these values, you spend generously on them without guilt, and you cut ruthlessly everything that does not align. The person who loves travel and values experiences might spend heavily on trips while keeping housing and transportation minimal. The person who values creative work might invest in tools and education while minimizing everything else. The person who values family might prioritize experiences with loved ones while being indifferent to possessions and status markers. The wealthy who report high satisfaction almost always describe some version of this approach. They know what they value, they spend accordingly, and they feel no conflict because their spending reflects their genuine priorities rather than external expectations. This clarity eliminates the guilt that comes from spending on things you do not actually care about, and the regret that comes from not spending on things you do care about. Topic: The power of contentment. There is a state that many people pursue through acquisition, but that cannot actually be purchased. And that state is contentment. The feeling that what you have is enough, that you are satisfied with your situation, that you do not need more to be happy. Contentment is not the same as complacency. You can still pursue goals and growth while being content with your current position. But it means that your well-being does not depend on achieving those goals, that you can be happy now, rather than only happy later when you have more. The pursuit of contentment through acquisition is self-defeating, because as we have discussed, the hedonic treadmill adjusts your expectations to match your circumstances, so that more never feels like enough. If your contentment depends on reaching some level of wealth, you will find when you reach it that the level has moved and you need more. Still, the only way out of this trap is to cultivate contentment directly as a practice, rather than as an outcome of acquisition. This cultivation might involve gratitude practices, or meditation, or deliberate attention to what you have, rather than what you lack, or simplification of desires, or acceptance of impermanence, whatever form it takes. The practice of contentment is ultimately more valuable than any financial strategy, because it provides directly the satisfaction that people mistakenly believe money will provide. The wealthy who are genuinely happy have almost always discovered this. They have stopped expecting wealth to make them content and have found contentment through other means, and then they are free to enjoy their wealth without needing it for happiness. Topic: Anti-Fragility in finances. There is a concept developed by the scholar Nassim Taleb called anti-fragility, which describes systems that actually benefit from stress and volatility, rather than merely surviving it. The opposite of fragile is not robust, which simply resists damage, but anti-fragile, which gets stronger when challenged. And this concept applies directly to financial planning. Most people build financial lives that are at best robust. They can survive some amount of stress, but they do not benefit from it. The truly wealthy often build financial lives that are anti-fragile, that actually improve in the face of volatility and uncertainty. Anti-fragility in finances might mean holding enough cash to buy assets when prices crash, turning market stress into buying opportunity. It might mean having skills and relationships that become more valuable during disruption when others are struggling. It might mean maintaining optionality, the ability to change direction when circumstances change, which allows you to exploit opportunities that others cannot pursue. It might mean avoiding hidden fragilities like concentrated positions or excessive leverage that seem fine in good times, but collapse when stress arrives. Building anti-fragility requires thinking about not just expected outcomes, but also about what happens in extremes. It requires building in buffers and options and flexibility that might seem excessive in normal times, but that prove invaluable when things go wrong. The person who is prepared for the worst scenarios is not being pessimistic. They are being realistic about uncertainty, and their preparation may actually allow them to profit from disruptions that devastate others who assumed good times would continue forever. Topic: Recession Preparation. Economic recessions are inevitable features of modern economies. They have occurred regularly throughout history, and they will continue to occur in the future, and yet most people are unprepared when they arrive, having assumed during good times that good times would continue. Indefinitely, the wealthy tend to be more realistic about the cyclical nature of economies, and they prepare for recessions even when there is no sign of one on the horizon. Preparation for recession involves building larger emergency reserves than might seem necessary in good times, because the emergency is coming eventually. Even if you do not know when, it involves reducing fixed expenses and commitments that become burdens when income drops. It involves avoiding excessive debt that can become crushing when income declines or assets fall in value. It involves maintaining skills and relationships that provide backup options if your primary income source disappears. It involves holding some liquid assets that can be deployed to buy when prices are low, turning crisis into opportunity preparation. Also involves psychological readiness, understanding that recessions are normal, not catastrophic, that they eventually end, and that panic and despair are not helpful responses. The person who has lived through recessions before and who has thought through how they will respond is calmer and makes better decisions than the person who is experiencing their first recession and who has no plan. The wealthy often describe recessions as clarifying and purifying events that exposed what was real and what was illusion, that tested their preparation and that created opportunities for those who were ready. And the key to being ready is preparing before there is any sign of trouble, because by the time trouble arrives, it is too late to prepare. Topic: Windfalls and Inheritances. When significant money arrives unexpectedly, whether through inheritance or insurance payout or legal settlement or business sale, most people are not prepared to handle it wisely. The psychological research on windfalls shows that they are often squandered, with the recipient returning to their previous financial state within a few years, having spent or lost the windfall without lasting benefit. This happens for several reasons. The money does not feel earned, and so it is treated less carefully than earned money would be. The amount often exceeds the recipient's experience with money, and they do not know how to manage it. The arrival creates pressure from others who want to share, and it disrupts established financial habits without replacing them with new ones. The wealthy who have received windfalls and maintain them often describe deliberate strategies for handling the transition. They took time before making major decisions, letting the emotional charge of the windfall dissipate before committing to anything they sought. Professional advice from fiduciaries who could help them understand their options. They were extremely cautious about lifestyle inflation, recognizing that a one-time windfall could not support permanently increased expenses. They were careful about who they told, understanding that publicizing sudden wealth invites problems, and they focused on preservation rather than immediate enjoyment, recognizing that the windfall represented an opportunity for lasting security rather than temporary pleasure. The key insight is that receiving money is not the same as being prepared for money, and that windfalls require preparation just like any other financial event. Topic: Divorce. Financial reality. There is a financial reality to divorce that many people do not fully appreciate until they are in the midst of it. And that reality is that divorce is one of the most financially devastating events that can occur in a life, splitting one household into two, approximately doubles expenses, while typically reducing income available to each party. Assets accumulated over years or decades are divided often in ways that feel unfair to both sides. Legal fees consume substantial resources, debts may be divided or assumed unevenly, and the financial trajectory that seemed stable is suddenly reset backward. The statistics on divorce and wealth are sobering. Divorce dramatically increases the probability of poverty, especially for women with children, and the financial effects persist for years or decades after the legal process is complete. The wealthy who navigate divorce without financial devastation often describe careful attention to the financial details, not letting emotion override analysis. They describe understanding their complete financial picture before negotiations begin, knowing what they own and owe and what they need going forward. They describe being realistic about what is achievable rather than fighting for everything and losing much of it to legal fees. They describe thinking about long-term well-being rather than short-term victory. And they describe rebuilding deliberately after the divorce, establishing new financial systems and goals. Rather than drifting in the aftermath, none of this makes divorce easy, but understanding the financial stakes and approaching them with clarity can reduce a devastating blow to merely a serious setback. Topic: Marriage and money alignment. Given the financial stakes of marriage and potential divorce, the wealthy tend to approach the financial aspects of marriage with more deliberation than others. They talk about money before marriage, understanding each partner's values and habits and expectations around spending and saving. They discuss debt openly so that there are no surprises. After the legal union, they agree on how finances will be managed, whether jointly or separately, or some combination. They create prenuptial agreements when substantial assets are involved, not because they expect divorce, but because clarity in advance prevents conflict later, and they continue to communicate about money throughout the marriage, keeping both partners informed and aligned, even when one partner handles the day-to-day financial management. This deliberation is sometimes seen as unromantic, as if love should transcend practical concerns like money. But the experience of the wealthy suggests the opposite, that financial conflict is one of the primary causes of marital stress, and that clear communication and agreement about money actually supports love rather than undermining it. The couple that avoids financial surprises and shares financial goals has one less source of friction than the couple that does not. And over a long marriage, that reduced friction compounds into a stronger relationship. This does not mean every couple must agree on every financial detail. Reasonable people can disagree about spending and saving, but the disagreements should be known and managed rather than hidden and discovered later, when they have grown into resentments. Topic: Children and Wealth. Paradox. There is a paradox that wealthy parents face regarding their children, which is that providing too much can be just as harmful as providing too little. The child who receives everything never develops the capacity to earn or manage resources, and may be left helpless when the parental support eventually ends, while the child who receives nothing may struggle unnecessarily and miss opportunities that parental resources could have enabled. Finding the balance between these extremes is one of the most difficult challenges of parenting with wealth. Many wealthy families have failed at this, producing entitled children who consume inherited wealth without creating anything of their own, and who are unhappier than they would have been with less, because they lack purpose and capability. The wealthy who navigate this paradox successfully often describe deliberate strategies. They provide opportunity, but not outcome-funding education, but requiring their children to build their own careers. They delay access to wealth until children have demonstrated capability sometimes, through trusts that release funds at certain ages or achievements. They model productive engagement with money rather than conspicuous consumption, showing their children that wealth is a tool for building and contributing. Rather than just spending, they require work even when it is not financially necessary, so that children understand the connection between effort and reward. And they are explicit about expectations, communicating directly about values and responsibilities, rather than assuming their children will absorb the right lessons by osmosis. The goal is children who could succeed regardless of their inheritance, and who see inherited wealth as additional resource, rather than as replacement for their own capability. Topic: Social Security Optimization. For those in countries with social security systems like the United States, understanding how to optimize benefits can significantly affect lifetime income, because the decisions around when and how to claim benefits are more complex than they appear, and the wrong decisions can cost tens of thousands of dollars or more. The basic choice is when to begin receiving benefits, with earlier claiming meaning. Smaller monthly payments for a longer period and later claiming meaning. Larger monthly payments for a shorter period. The break-even analysis depends on longevity. If you live a long time later, claiming usually wins, and if you die earlier, claiming would have been better. But beyond this basic trade-off, there are strategies involving spousal benefits, survivor benefits, and coordination between spouses that can substantially increase total lifetime benefits. The wealthy tend to approach Social Security strategically, treating it as they would any other significant financial decision. They understand their options thoroughly. They consider their particular circumstances, including health and other income sources. They coordinate with their spouse if married, and they often delay benefits longer than the average person, both because they can afford to wait and because they tend to live longer. So the later benefits pay off for many people. Social Security will be their largest source of retirement income, even if they have saved substantially. And optimizing this income source is one of the highest value financial activities they can undertake. And yet many people simply claim at the earliest opportunity, either because they do not understand the trade-offs or because they cannot afford to wait, missing out on substantial lifetime income as a result. Topic: Tax loss. Harvesting. There is a strategy used by sophisticated investors called tax loss harvesting, which involves deliberately selling investments that have declined in value in order to realize a loss for tax purposes, and then using that loss to offset gains elsewhere or to reduce ordinary income up to certain limits. The investment can be immediately replaced with a similar but not identical investment, so that portfolio allocation is maintained while the tax benefit is captured. This strategy is entirely legal and explicitly accommodated by tax rules. And over time, it can significantly increase after-tax returns by deferring taxes that would otherwise be owed now into the future, and by converting short-term gains taxed at higher rates into long-term gains taxed at lower rates. The wealthy and their advisors often harvest losses, systematically reviewing portfolios, specifically for harvesting opportunities, especially toward the end of tax years. When gains and losses for the year are clearer, they maintain awareness of the wash sale rule, which disallows the loss if a substantially identical security is purchased within 30 days, and they track cost basis carefully to ensure losses are accurately calculated. The strategy is more complex than it might seem, because it requires careful record keeping and awareness of tax implications, and it may not be worthwhile for small portfolios where the tax savings do not justify the effort, but for substantial portfolios, managed thoughtfully. Tax loss harvesting is one of several strategies that separates sophisticated investors from naive ones. Each small optimization compounds over time into significantly better outcomes. Topic: Asset location strategy. Related to tax optimization is a concept called asset location, which is distinct from asset allocation. Asset allocation is what you own the mix of stocks and bonds and other investments in your portfolio. Asset location is where you hold those investments, which accounts contain which assets this matters, because different accounts have different tax treatment. Traditional retirement accounts are tax deferred, so investments there grow without immediate tax, but withdrawals are taxed as ordinary income. Roth accounts are tax-free, so investments there grow and can be withdrawn without any taxable accounts, are taxed currently on dividends and capital gains, but at potentially lower rates than ordinary income. The optimal strategy is generally to place investments that generate a lot of taxable income, like bonds, and actively manage funds in tax-advantaged accounts, where that income is sheltered, and to place investments that generate qualified dividends and long-term capital gains in taxable accounts, where those types of income receive favorable treatment. The wealthy and their advisors spend considerable effort on asset location, because over a lifetime, the tax savings can be substantial. It is one of those technical details that has real dollar impact, but that many investors ignore either because they do not understand it or because it feels too complicated to implement. Properly, the principle is simple: place investments, optimally given the tax characteristics of both the investments and the accounts that hold them, but the execution requires understanding tax rules and maintaining awareness of what is held